Okay, so very good evening, all of you. Yesterday I gave you two questions to solve. Okay, try at home. So I'll discuss those questions right now. Okay, and let's see whether you were able to solve them or not. Okay, let's see. See, question number 3 from your practice questions. Mr. Ramesh and Mr. Suresh are brothers. They are they earned following incomes during the financial year 2024-25. Mr. Ramesh settled in Canada in the year 1996 and Mr. Suresh settled in Delhi. Meaning that since 1996, Ramesh is in Canada only. He settled there. And since that time only, Suresh is settled in India, in Delhi. If nothing is mentioned regarding their stay in India, outside India, during the previous year 24-25, what we are going to assume that Ramesh, who has settled in Canada, is still there only. He has not come for a single day in India during 24-25. And at the same time, we'll assume that Suresh, who is there in India since 1996, he is there in India for the full year in 24-25. Meaning that the residential status of Ramesh would be non-resident in this year, and the residential status of Suresh for this year will be ROR. Because since 1996 he is there in India. This year also full year he is in India, meaning that he is ROR. Since 1996 onwards, Ramesh is outside only and he has not come to India for a single day, hence he is a non-resident. So we got the residential status for both the brothers, yes or no? So what will be the residential status for Ramesh? Come on, tell me. It will be NR. And what will be for Suresh? It will be ROR. Okay. Now we are supposed to look at these incomes which they are earning during the previous year 24-25, and based on their residential status, which we have just now determined, we are supposed to say that whether these incomes are taxable for them in India or not. See, as far as Ramesh is concerned, whose residential status is non-resident, all the incomes which are Indian incomes will be taxable for him. All the incomes which are foreign incomes, either part A or part B, will not be taxable for Ramesh. Yes or no? And about Suresh, all the incomes, whether Indian incomes or foreign incomes, part A or part B, will be taxable for Suresh. Yes or no? Okay. Now, see, compute the total income. They are telling you to compute the total income for assessment year 25-26, assuming both have exercised the option of shifting out of the default tax regime. Meaning that they have shifted out of default tax regime, meaning they are following the normal tax system. Yes or no? Now, interest on Canada development bonds, only 50% interest received in India. Yesterday, we did UK development bond. Today, they are saying that this is Canada development bond. The same thing is given, but instead of one country, now they have changed the name of the country. The treatment remains same, which we gave yesterday. Come on, tell me, the entire interest will accrue in Canada. But out of that, if 50% is received in India, that is Indian income, tick, tick, tick. Okay? Meaning that will be taxable for non-resident as well as ROR. That will be taxable for Ramesh also as well as Suresh. 50%, the part which is received in India. The part which is received outside India, that means out of the entire interest, half interest which is received outside India, that is accrued outside India, received outside India, that is a foreign income, will not be taxable for non-resident, but that will be taxable for resident. So if I say that out of the total 35,000, half is received in India, half is received outside India, the half which is received in India will only be taxable for Ramesh because his status is non-resident. Yes or no? So what we will be doing here, out of this 35,000, we will be charging only 17,500 taxable in the hands of Ramesh. Okay. Now, as far as Suresh is concerned, out of 40, the 20 which he is receiving in India and the 20 which he is receiving outside India, irrespective of that fact, that entire 40 will be taxable for Suresh because his residential status is ROR. Understanding? Sure? Okay. Now, the first part is done. So, first income is taxable for both. But only half taxable for Ramesh and full taxable for Suresh. Next one, dividend from British company received in London. Now tell me, this is also a foreign income. Part B, foreign income. Not taxable if you are a non-resident. So I will cut this part. But it will be taxable if you are ROR. Because for ROR, even part A as well as part B foreign incomes are taxable. Yes or no? So this entire 40 will be taxable. This entire 20 will be taxable in the hands of Suresh. Next one, profits from a business in Nagpur. Nagpur is a place. It is a place. It is a town in India. So if your business is in India, from that business, whatever income you are earning, don't you think that is accrued in India? That is Indian income. Now, what difference does it make that it is managed from London or wherever it is managed from? We don't mind as far as the business is in India. Entire income is accrued in India. Entire income is Indian income. It will be taxable for non-resident also. It will be taxable for ROR also. Yes or no? So this will be taxable. This will be taxable. Yes or no? Next one. Short-term capital gain on sale of shares of an Indian company received in India. Wow, wonderful. The shares of an Indian company you are selling in India and the gain also you are receiving in India. What if you would have received this gain outside India? Then also it would have been your Indian income, because that time it would be your deemed to accrue or arise in India, section number 9 income. Yes or no? But right now, the income is accrued also in India, received also in India. It is your Indian income, taxable if you are NR also, taxable if you are ROR also. Done? Next one. Income from business in Chennai. Very good. Accrued in India. This is your Indian income, taxable, taxable. Next one. Fees for technical services rendered in India but received in Canada. Where the technical services were rendered? It was rendered in India. And for any technical services which are rendered in India, whatever fees you are receiving, that is deemed to accrue or arise in India if it is received outside India. Yes or no? So section number 9 says that this is your Indian income deemed to accrue or arise in India, taxable for non-resident, as well as ROR. But ROR is not earning that income, so it will be taxable in the hands of Ramesh. Yes or no? Next one. Now, interest on savings bank deposit in UCO Bank, Delhi. Hello. Do you remember yesterday I told you one small chart? Savings account in a bank in India will give you interest. That is your Indian income. First of all, it is taxable. Then later on, up to 10,000 of that amount you can claim as a deduction under 80 TTA. Understanding? So first what we will do, we will charge it taxable. Then for this, we will claim 80 TTA deduction from the GTI. That 80 TTA deduction will be available for both. But for Ramesh, it will be entire 7,000 allowed under 80 TTA because that is within the limit of 10,000. But for Suresh, it will be allowed to the extent of 10,000 only. Getting my point? Everyone? Okay. Now, agricultural income from land situated in Andhra Pradesh. Andhra Pradesh means the land situated in India. This agricultural income is fully exempt under section 10(1), will not be taxable in the hands of both. Neither in the hands of Ramesh nor in the hands of Suresh. Rent received in respect of house property at Bhopal. Wait. What they are saying? They are saying rent. They are saying rent. Rent means this is income which will be taxable under the head house property. But from that, we are supposed to take 30% standard deduction also. They are not saying that this is computed income under the head house property. So we are supposed to take 30% standard deduction. And then whatever balance remains, that balance will be fully taxable because the property is situated in India. This is Indian income. It will be taxable for both. So what I'll do, I take 30% standard deduction from here and this amount will be 70,000. And I take 30% standard deduction from here, this will be 42,000. Yes or no? So this 70 will also be taxable, this 42 will also be taxable. Yes or no? Next one, life insurance premium. See what happens now. Whenever you pay life insurance premium, that is not something which is coming to you. This is your expense. So whenever you pay your life insurance premium, for that premium, you usually get deduction under section 80C. So there is one section 80C. Under that 80C, you are going to get the deduction for this life insurance premium paid. But that 80C deduction you will be claiming after calculating your GTI. So first calculate your GTI. From that GTI, now you will get two deduction. One, under section 80C, you will get this deduction for life insurance premium. And 80 TTA, you will get the deduction for interest on savings deposit account. Yes. So for this, we'll take ATC deduction. Now very easy. What we are supposed to do? We are supposed to make a table, particulars. Then in that we'll write Ramesh and we'll write the status there only, non-resident. And another column, Suresh, will write the status ROR only. And now one by one we'll start writing the incomes. First income, accrued outside India, underline. Received in India, next line, received outside India. Received in India, 17,500. And here 20,000. Next one, received outside India dash, because Ramesh is non-resident, that 17,500 is not taxable. And for Suresh, the another 20,000 which is received outside India will be taxable for him. So what will be the total income total of these two interest taxable for Suresh? It will be 20 plus 20, 40. And what will be for Suresh? It will be 17,500 plus 0, it will be 17,500. Likewise, you are supposed to present. Got it? Sure. Now, second one, dividend from British company. You will write down accrued outside India and received outside India. First column dash, second column 20,000. Likewise, you are supposed to write down all the incomes which are taxable. Don't write those incomes which are not taxable. Put a dash. Now, first one, tell me what will be the total income of Ramesh? 17,500 plus you don't add 28,000. Okay. Premium is not to be included, no, Akshay? Premium is paid, no? See, it is only about interest income which you are earning. You show it taxable and then take the deduction. Two effects. But for premium, it is your payment only, no? So take the deduction only. That's it. Understood? Next one. See, 17,500 plus don't add 28,000. Then add 1 lakh. Then add 60,000. Then add 80,000. Then add 1 lakh. Then you will add 7,000. Then don't add 55,000. Add 70,000. Then you will get a total of 4,34,500. First column. 4,34,500. So can I say here the gross total income for Ramesh, it is 4,34,500. And what will be the gross total income for Suresh? Come on, check. 40,000 plus 20,000 plus 1,40,000 plus 90,000 plus 70,000 plus 12,000 plus don't add 45,000. Okay. Then add 42,000. You will get 4,14,000. So did you get 4,14,000? Okay. Now this is your GTI, gross total income. Out of that you will get deduction under chapter 6A. First deduction which you are going to get will be 80C. That is for life insurance premium. Who is paying life insurance premium? Ramesh or Suresh? Only Suresh. So Suresh will get the deduction out of his GTI. Yes or no? So for Ramesh, we will put a dash. And for Suresh, what we will do? We will take 30,000 deduction for life insurance premium. Another 80 TTA. That is what? Interest on savings account. What was for Ramesh? It was 7,000. 7,000 shown as income and now 7,000 taken as a deduction. Okay. And for Suresh, how much was the interest? 12,000. 12,000 included. But we will not take the deduction of 12,000 because 80 TTA maximum limit only is 10,000. Yes or no? So we'll take 10,000 over here. Now what you will do? 4,14,000 minus 30,000 minus 10,000. You will get 3,74,000 here. And 4,34,500 minus 7,000. You will get 4,27,500 here. This is the total income for both the brothers. Done, everyone? Easy? Very easy question, but it was important. Mark this question important and please pay attention. See, this kind of question they can ask you in exam. And if such question comes, no, trust me, it will be for minimum 6 marks. What they will do, see, in this question, no, they have not told you to determine the residential status. At the most, what difficulty level they can give you in the exam, I'll tell you. They will give the number of days stay of Ramesh also, and number of days stay in India for Suresh also. They will tell you that Ramesh was outside, he came to India on this date, he left on this date. Okay, Suresh was already in India, he left India, then again came back to India. They will make you determine their residential status by giving some number of days, so that this residential status part become a little bit more difficult for you. Then at the most what they can do, in this same type of question, they can twist few incomes out of this. We have solved a very difficult question, a question which was difficult than this. Yes or no? What they will do? They will they will take 2-3 adjustments from that question and they will put it here and remove 1 or 2 from here. Mix and match, new question created. Concept remains same, no? Conceptually, if you are clear, no, what they are trying to ask you, you will be always able to solve the questions. Don't worry about it. But the confidence will come only if you solve the maximum questions. And you have this mindset that, okay, what if in this question they are trying to do like this? What if in this question they are trying to do like that? You should have that kind of mindset. Only then you will, think. And only then when the new type of question will come in the exam, no, see, I will solve 500 questions with you in class. For example, you are going to definitely see 501st new question in the exam. This will not be exactly the same question which we are solving, but they will try to mix and match 2-3 questions. But all the questions you have solved, similar type of questions, they will mix and match and they will try to create a new question for you. And people get afraid, students usually get afraid. Oh my God, what happened? What type of question they have asked? Sir, we are not able to solve. If you are conceptually not strong, if you have not studied the concepts properly, and if you have not practiced the question, no, trust me, you will not be able to solve a single question in the exams. And that is what, many students face as a difficulty. And I don't want you all to face that difficulty. The moment you are sitting in the exam, no, you are confidently going in the exam, sitting there, and my voice is echoing in your ears. That, okay, sir is telling all these things. Sir is, dictating the answers and we are writing. That should be the level of confidence. And that will be built only if you are attentive and do the things which I am telling you to do religiously. Okay. So this was your question number 3. Now we are going to solve question number 5. Okay. See, this is a simple question. In this question, they are telling you that, see, this is your income. Tell us whether this income is taxable for you or not. If taxable, then how much amount is taxable and what is the reason for taxability? If not taxable, then why it is not taxable? Give the reason. In this question, we are supposed to answer like this. Understood? See, examine with reasons. They are saying examine with reasons. You are supposed to give the reasons also. Whether the following transactions attract income tax in India. That means whether the transactions are taxable incomes or not. In the hands of recipient. Salary payable by the central government to Mr. John, a citizen of India, rupees 7 lakhs for the services rendered outside India, considering that he pays tax as per the provisions of 115 BSE. Wait, no. In the last question, come to the last question first. In the last question, they were telling you that he has shifted out of 115 BSE. Now, you should have one doubt in your mind. What if in the same question, if they are saying that not shifted out of 115 BSE, following 115 BSE, then that deduction of ATC and ATTTA we took now will not be available. And accordingly, what will be your total income? Total income will be this much only, without taking the deductions. Because when you follow 115 BSE, there are many deductions and many exemptions which they take away from you. Out of all those deductions and exemptions, ATC and ATTTA is also there. All the chapter 6 deductions are gone. You will not be allowed any deduction. So is it better for us? No. Why? Because if we are able to get the deduction and reduce our total income, So it is always better to pay tax on a lower total income, no, rather than paying a tax on higher total income. Yes or no? But if you follow 115 BSE, these deductions will go away from your hands. And whatever gross total income was there, that will only become your total income now. And on that you will have to pay tax. And even if the rates are concessional, there will not be much benefit for you. Getting my point? In that same question, they can ask you like this. One more question we solved earlier, last lecture. In that question also they had said that 115 BSE is not followed. Then your answer is there. What if 115 BSE is followed there? There also 80 TTA deduction will not be available. And that case, the standard deduction and everything, that will be okay. So as and when we'll move with the chapters, no, in the chapters only I keep on telling you, see, we are doing this deduction, we are doing this, we are doing that. Wait, this deduction will not be available if you follow 115 BSE. That time only I will tell you. So that along with the chapters only, we are learning that what is applicable under 115 BSE in this chapter and what is not applicable if we follow 115 BSE. Yes or no? Otherwise, the entire chapter will be solved as if we are not following 115 BSE. Entire chapter will be done as if we are not following 115 BSE. But what if we follow 115 BSE? What changes will be there in this chapter? Chapter wise, I will keep on telling you. And once we are into the tax rates now, in the tax rates, we'll be going to discuss the tax rates of 115 BSE now. That time when I will show you 115 BSE, you will say, sir, we have already studied all these things with the chapters. It will be just a, exercise of reading all those things. That's it. Got it? So let's come to question number 5. What if you are following 115 BSE? Shifted out, not, yes, considering to pay tax as per the provisions of 115 BSE. I told you yesterday, if you are earning salary for rendering services outside India as an Indian citizen and that salary is given by government, what will happen? That salary will be deemed to occur or arise in India will be taxable for you. So can I say Indian citizen John, the salary will be taxable? Yes or no? If the question is silent, no, Akshaya, if the question is silent, no, by default 115 BSE is applicable by default because that is a default tax scheme, no? But don't worry, they are not going to put you in suspense like this. Majority of the questions they will tell you only that 115 BSE opted or opted out. They will tell you. Okay, next one. See, so here can I say this 7 lakh is taxable? But don't you think that this 7 lakh is salary? It will be taxable under the head salary. So from that salary head, final income needs to be calculated. So to calculate that salary head final income, we are supposed to take standard deduction also out of this salary because this is not salary computed, this is salary paid. Salary paid will be shown under salary head. From there, you will take the deduction, standard deduction, then you will get salary computed. Yes or no? So we are supposed to calculate salary computed. So how will we be able to do it? We are supposed to take the standard deduction out of this. Whatever remains will be treated as our salary computed. Yes or no? So how much will be the standard deduction? If you follow 115 BSE, then under the head salary, your standard deduction will be 75,000. But if you don't follow 115 BSE, under the salary head, your standard deduction will still be there, but it will be only 50,000. So tell me how much standard deduction you will get? 75,000 because he is following what? 115 BSE. So out of 7 lakh, can I say 75,000 standard deduction is taken? 6 lakh. 25,000 will be the taxable income. Yes or no? So what reason you will give? You will give that this income is covered by section number 9. It is deemed to occur or arise in India, hence it is taxable. But we are taxing it after taking standard deduction 75,000 because he is following 115 BSE. That answer you are supposed to write in your own language. Okay. Go and check the solution. In the solution, you will get the same answer. Taxable 6,25,000 and the reason will be same which we have discussed now. Okay. Next one. Interest on money is borrowed from outside India, 5 lakh by a non-resident for purpose of business within India, say at Mumbai. Wait. You are an assessee. Okay. Interest on money borrowed from outside India by a non-resident. Money borrowed outside India by a non-resident. So who is borrowing money from you? Non-resident is borrowing money from you. Who is outside? So on that borrowing, he is giving you interest. But that borrowing, that loan, he is using to do a business in India. So is that non-resident using your money in India? Yes. And on that money, if he is giving you interest, don't you think, even if it is coming from non-resident, it is deemed to accrue or arise in India? It is your Indian income. So it will be taxable, because this is also covered by section number 9, deemed to accrue or arise in India. How much is the answer? 5 lakh. Please check. Please check the answer. 5 lakh is taxable or not? Sure. Next one. Post office. Now see, yesterday only, we did one chart. In that chart I showed, wait, I'll show you that chart. Do you remember this chart we did yesterday? Savings deposit account, if in a post office you are having a savings deposit account, from that savings deposit account, whatever interest you are earning, up to 3,500, it is exempt under section 1015. So tell me how much post office interest you are earning? You are earning 19,000. So out of that 19,000, first 3,500 will be exempted. So how much remains? 19,000 minus 3,500, 15,500 remains. That 15,500 is taxable. But don't you think that 15,500 will be taxable under the head IFOS, will be ultimately shown as a part of your GTI, and for that you will get deduction under ATTTA up to 10,000. So out of this 15,500, 10,000 will be allowed under ATTTA. So how much will remain now? Only 5,500. So ultimate final amount which will be taxable in the hands of the assessee will be 5,500. How did you arrive at? See, out of 19,000 interest, 19,000, some interest was exempted under section 1015 amounting to 3,500. Yes or no? So you will get 15,500. This is taxable amount, and out of that, after considering ATTTA deduction amounting to 10,000, whatever remains 5,500 will only be taxable final amount, and this will be taxable in the hands of all types of assessee, whether the assessee is ROR, RNOR or NR. Okay. Next one. Royalty paid by resident to a non-resident in respect of a business carried outside India. Wait. You are an assessee. You are a non-resident. Royalty paid by a resident to non-resident. So you are a non-resident. You are receiving royalty from a resident. Usually it is deemed to accrue or arise in India. But one exception was there. If the royalty is received from a resident, and if it is for a business outside India, then the royalty, even if coming from resident, will not be deemed to accrue or arise in India. So this is not deemed to accrue or arise in India. Hence, this will not be taxable. Because if it is paid to non-resident outside India, so for non-resident, this is not deemed to accrue or arise in India. This is accrued outside India, because it was for a business which was outside India. For example, some patent etc. is used for a business outside India, and on that patent, whatever royalty is coming, that royalty is accruing from outside India, and non-resident is receiving that outside India. So for non-resident, accrued outside India, received outside India is a foreign income, no? Will it be taxable or not taxable? Not taxable. In the hands of non-resident, this will not be taxable, because it is accrued also outside India, received also outside India. This is not deemed to accrue or arise in India. Done? Next one. Legal charges 5 lakh paid in Delhi. Done. Paid in Delhi. So whoever getting that legal charges, he is getting that legal charges in India, receiving that legal charges in India. So for him, that legal charges is what? Indian income, because receipt happens in India, that receipt and Indian income. Done? So tell me, lawyer of United Kingdom visited India to represent a case at Delhi High Court. See, if you are representing a case at Delhi High Court, that means as a lawyer you are rendering your services in India. And for those services which you are rendering in India, the legal charges are accruing in India, and on top of that, it is received also in India. What type of income it is? Indian income. So even if that lawyer is from United Kingdom, even if his status is non-resident, will not make any difference, because that lawyer is earning this income from India, also receiving in India. For that lawyer, this income is Indian income. What will be the answer? Taxable. How much amount will be taxable? Entire 5 lakhs will be taxable. Got it? So these type of questions can come in the exam. Please be very careful. Okay? And these kind of questions, the small parts like this can come in the main answer also, main question also, as an adjustment, or it can be framed as an MCQ. Done? So with this, the chapter is over. Now we are going to start with new chapter. The name of the new chapter is income from house property. Done? No? Okay, let's start with the new chapter now. Okay, so the name of your new chapter is income from house property, right? How many heads of income are there? If I ask you how many sources of income are there, you cannot say 5. No, there are many sources of income giving you income. Out of those income, certain sources can give you taxable incomes, and the sources which are giving you taxable income, out of those taxable incomes, certain incomes will be covered in your scope, and based on them you will calculate your total income. Yes. So how many sources of income are there? Many sources giving you taxable income, and those taxable incomes are covered in your scope also as per section 5. Now the incomes, sources and their incomes which are getting covered in your scope, now you will have to classify these incomes into 5 heads. How many heads? 5 heads. First head is salary. Second, income from house property. Third, business and profession. Fourth, capital gain. And the fifth head is income from other sources. Now wait, from all the sources of the previous year, you are earning some taxable incomes. These taxable incomes are covered in the scope of your total income, meaning you are supposed to include these incomes in the computation of your total income. Now you are having those taxable incomes, those sources and taxable incomes which are supposed to be shown by you in the computation of your total income. Now out of these incomes, some incomes will go to salary head, and from them the salary head income will be computed. Out of these sources, some sources and their incomes will go to house property head. Some sources and their incomes will go to business or profession. Some sources and their incomes will go to capital gain. Some will go to other sources. Now, once you classify the sources and their incomes under 5 heads, no, then computation of 5 heads has to be done. Some incomes taken to salary. Now, from that income, compute salary head income. Some incomes taken to house property. From that, now calculate house property head income. Yes or no? So like this, we are supposed to calculate the income under 5 heads now. So first head is salaries, but that is comparatively bigger. And see, if we are trying to get into a rhythm, so let's start with a comparatively easier topic. So the head number 2 is house property, but we are doing it for first, prior to salary. Okay. So that a rhythm builds, and we also find some confidence. Okay. Heads are also easy, and actually heads are easy. But out of 5 heads, no, the difficult head which the students consider, that PGBP and capital gain are there. So to make you all, matured till the level of PGBP and capital gain, I will have to start with scratch, start with very, easy heads. First we'll start with one easy head. The name of that head is house property. Then we'll go to salary. Then we'll go to PGBP. Then we'll go to capital gain. And last, income from other sources. So like this, we will be moving ahead. Okay. So the first head is salary. Second head is house property, but we are starting with house property first. Okay, no? So tell me, under the head house property, what incomes you will bring, what sources of income you will bring, and what incomes you will bring. And by taking those incomes, how you will determine the income from this head. The provisions are given in section 22 to section 27. These sections you are supposed to do. Okay. So what all is there in these sections? It is there on your screen. Please check. This is the theory which you are supposed to study. This is the syllabus under this head, content of this head. We are supposed to read all those things. First section 22 we'll do, then we'll do section 23, then 24, 25, 25A, 26, 27, and few small important concepts also. Yes or no? Once we are through with all these things, no, this head will be over. Very easy head, and you'll, enjoy the calculations also. Done? Shall we start? Okay. Now see, any head, I told you there are 5 heads of income. So under any head, the first section of that head will be the charging section for that head. Whenever you get into a head, so you will see the first section under that head. That first section of that head is the charging section for that head. That section will tell you which sources and which incomes will come to this head. So that charging section will tell you the charge. Which incomes will be charged under this head? What are the conditions which needs to be satisfied in order to charge an income under this head? Yes or no? So if we talk about house property, if we talk about salary, salary starts from 15 to 17. Then house property starts from 22 and it goes till 27. Then business and profession heads, that starts from 28 and it goes till 44 dB. Then capital gain, it will start from 45 and it will end on 55A. Then IFOS will start from 56 and it will go till 59. Can you see the first section under every head? These are known as charging section. They're just like gatekeepers. They will allow you inside that head. So which incomes are allowed to enter in this head is decided by this gatekeeper, which is nothing but the charging section. What are the conditions which needs to be satisfied to bring an income under this head? Okay, what source will come, and from that source, what income will be charged under this head? Okay, now once the income comes in this head, then other provisions under the head are computational provisions. They will tell you that from this income, what all deductions are allowed, what all things are not allowed. Remember those things. Take these deductions, don't take these deductions, disallowances, etc. Few important points, and then whatever final remains, that will be the income of that particular head. So these are the computational provisions of each head, and the first section is charging section. Okay, so you might be wondering that after salary and before house property, few sections are missing. You might have noticed. Tell me, after salary and before house property, section number 18 to section number 21 are missing. These are omitted sections. Earlier, there used to be a head After salary and before house property, there used to be a head. Under this head, dividend income and interest income used to get charged. Which incomes? Dividend income and interest income used to get charged. But the dividend and interest income is now covered under income from other sources. So there is no need to have a separate head for their chargeability. So that head was eliminated, omitted. Getting my point? And that head has which sections? 18 to 21. Those sections are no more in existence. Sure? Everyone? Go and ask any of your friends this today. You will come to know that they are knowing this or not. Okay. So now what we are going to study? Income from house property, section 22 to section 27. Okay. Now the first section, section 22, which talks about charge, known as charging section. Now what this charging section says? Wait. The annual value of any property consisting of annual value of a property consisting of any building or land appurtenant thereto, of which the assessee is the owner and not used by the assessee for his own business or profession, shall be charged under the head income from house property. Wonderfully written. They are saying that under this head annual value will be charged. What will be charged? Annual value will be charged. Whose annual value? Annual value of any property consisting of any building or land appurtenant thereto, of which the assessee is the owner and not used by the assessee for his own business or profession. So you should have a property. Property means asset. What type of property you should have? The property which we are talking here, the asset which we are talking here is nothing but any building or land appurtenant to building. We are not talking about all the assets. We are not talking about the annual value of all the assets. No. We are talking only about annual value of only that asset, only that property which consists of building or any land appurtenant thereto. And the building or the land appurtenant thereto, assessee should be the owner of that property. Assessee should not use that property for his own business or profession. Then whatever property which is satisfying all these conditions are there, bring those properties under this head. Calculate the annual value of those properties and charge that annual value under the head house property. Getting my point? So now reading this, we'll refine also this and we'll simplify also this. Don't worry. First of all, 3 conditions are there. First condition is you should have a building or land appurtenant thereto. We sweetly call it house property. So what is the meaning of house property? House property means any building or land appertinent to such building. Appertinent means attached, connected. Yes or no? So if there is a building or a land appertinent to such building, meaning attached to such building, that is known as a house property for this head. We call it what? House property. The assessee should be the owner of this house property. Without ownership, this house property will not come into this head. So if you want to bring any house, any property under this head for the assessee must be the owner of that house property. Yes or no? But wait, if the assessee is using that house property for his own business or profession, then the property will not come under this head. Then take the property to business head. Whatever will happen with this property will happen in the business head. No need to bring that property under this head, because that is being used by the assessee for his own business or profession. So how many such properties you can have? Tell me. Now I will say there are three conditions. First condition is you should have a house property. Second condition is you should be the owner of the house property. Third condition is the house property should not be used by the owner for his own use in own business or profession, should not be there. So there has to be a house property. The assessee should be the owner of that house property, and that house property shall not be used for the business or profession of the assessee. If all the three conditions are satisfied, then bring that house property under this head. Then annual value. What did I say? Annual value of all such properties will be charged under this head. Now tell me how many such properties you can have during the previous year. How many such properties you can have? One. You can't have two. Two properties of which you are the owner, not using for your business or profession. Can you have three properties? Yes. Can you have four properties? Can you have five? I have multiple properties. All the properties I am the owner, and I am not using any of those properties in my own business or profession. I will bring all those properties under this head. And now for each of that property, I will have to calculate the annual value. Because for every such property, its annual value is chargeable under this head. What is annual value, sir? Meaning of the annual value is rent earning capacity. Not the rent which you are earning from the property. No. But the rent earning capacity of the property will be charged. See, the government is very smart. Huh? If they would have told you, no, rental income of that property will be charged. Tell me, are we all honest people or dishonest people? Majority of us are dishonest people only. Kanu, understanding? No. So if they would have said that rental income will be charged, I will never show correct rental income for the purpose of charge. I have given the property on rent at 50,000. My property can earn 50,000 rent. I will tell my tenant, don't pay entire 50,000 in check. Pay only 20,000 and balance 30,000 in cash. How much rent I have earned? Only 20, sir. And you are saying, no, rental income will be charged. Charge rental income. Knowing that the property can earn 50,000, 50,000 can be charged, that poor fellow will have to charge only 20,000. Why? Because the charge was on rent. Now people like us, they will evade taxes like this. So that fellow, that officer, knowing that I can earn 50,000, cannot charge tax on 50,000. Knowing that I can earn 50,000 from my property, cannot charge tax on 50,000. I will tell him, I am earning 50,000. I am earning 50,000. But prove that I am earning 50,000. And if you cannot prove, no, I am earning 50,000, I'm offering 20,000, charge tax on this. And you are supposed to charge tax only on this amount because the charging section says that you have to charge tax on rental income. That they have to charge tax on 20. So while making this law, the lawmakers were very clear that the assessees will be dishonest people only. So to stop them doing all such kind of nonsense, instead of charging the rental income, charge the rent earning capacity. Now they will determine the rent earning capacity of my property if that rent earning capacity is approximately 45,000. So even if I will show 20,000, no, that will be ignored. Rent earning capacity was 45. Minimum 45 you can earn. Pay tax on 45. Now they will compel me to pay tax on 45,000. I was earning how much? 50. At least I'll be paying tax on 45, no? Sir, what if you are actually earning 20? You are an honest person. Then you are a fool. If your property can earn 45, why are you earning only 20? Getting my point? If 45 will be charged, no, then only I'll come to know, no, that my property can earn minimum 45. And I have given it on a rent for 20 only. So I will make efforts to now give the property for higher rent. That way I also will earn more and the government will also get more tax. Getting my point, everyone? Sure? So tell me, three conditions are there. First condition is house property. Second condition is assessee should be the owner of that house property. Third condition is that house property should not be used by the assessee for his own business or profession. If all the three conditions are fulfilled, all such properties bring under this head. Now, if all the properties are brought under this head, for every property, I will have to calculate what? Annual value, which is nothing but rent earning capacity. How to calculate this annual value? You will decide. Department will decide. No. How to calculate this will be determined by the law itself. Law will tell you. In that way, the annual value, rent earning capacity will be determined. Where it is written? It is written in section number 23. So right now we are under section 22, which talks about charging section. Let's understand section 22 in more detail. Once we are through with section 22, no, then I will bring you to section number 23. Then we will learn that for different types of properties, how to determine the annual value. Okay. And whatever annual value which will be determined, how it will be determined and how it will be taxed. That we are going to learn later on. But first of all, let us do the discussion of section 22. Let us do the post-mortem. Okay. First thing, can you see house property? What is the meaning of house property? Tell me. What is the meaning of house property? Should I tell you? Network is okay, no? Audio, video okay? Properly? Sure? Okay. So, pay attention. House property. First thing, house property. House property means any building. Any building is house property. Any means? Any means? Any. Four walls, a roof, a structure is a building. And if it is a structure, it is a building, it has to be your house property. Getting my point? Only video is clear. My voice is not coming proper. Audio, video, there is some problem. Akshay, Kanu, please check. Okay. Audio is clear. Now video is okay? Sure? There are some network glitches, I don't know. Because of some network issues it might be happening. Now it is clear, no? Okay, perfect. So, house property. Any building. Any building means the building can be residential in nature and it can be commercial in nature too. So all the residential buildings are house properties under this head. All the commercial buildings are house property under this head. Give few examples of residential buildings. Flat, bungalows, tenements, yes or no, row houses, all are used for residence. So they are residential buildings, residential properties, yes or no? They are house properties. But apart from that, any commercial building is there, even the commercial buildings are also treated as house property under this head. Commercial buildings means shop is there, godown is there, then cinema hall is there, office premises are there, factory buildings are there, you name it and you have it. All the commercial type of buildings are also house property only. See, the name of the head is no very deceptive, very deceptive. If you will go by the name of the head, no, you will be confused that how the rent of the shop is taxable under this head. How the rent of a godown is taxable under this head. Is it a house property? No. In general knowledge, for common man, it is not a house property. But this head consider these type of buildings also as what? House property. Getting my point, everyone? So any residential type of building or any commercial type of building, if it is a building, it has to be a house property. That's it. Sure? Now tell me, any part of the building is a building only. And if it is a building, it is a house property only. What do you mean by part of the building? Can I say terrace, roof? Roof is what? Part of the building only, no? What if you let out your terrace on rent to someone? The rental income will be charged under this head only. Because part of the building is also a building. It is a house property. What about walls? Walls of the building. It is a part of the building. Sometimes you can give the wall of your building also on rent. Your building is facing highway. So highway side wall you have given on rent to some ad company to put their hoardings and all. Sure? So that wall is also a part of the building. Walls are there, pillars are there, roof is there, yes or no? Any part of the building is also building only. And if it is building, it has to be a house property. Sure? Now, the third thing. Any land which is appurtenant. Appurtenant means attached to the building. So if you have a building, there has to be a land which is attached to the building. Meaning that that land forms part and parcel of that structure. That land does not have its own existence. It is not independent. It is attached or connected to building in such a way that it forms the part and parcel of that building, that structure only. For example, in my house, there is a small open space in my house. See, in South India and everywhere now, you see big houses are there. So all the rooms are made in a square format and there is some open space, within the house itself. That open space is nothing but land only. But that is connected to the building, appurtenant to building, attached to the building. When you sell the house, no, automatically that land, ownership of that land will also pass on. A garden space is there. A parking space is there. Yes or no? So all such lands which are connected or attached to the building in such a way that their own existence is not there, they are connected in such a way with the building that it is a part and parcel of that structure, part and parcel of that building only. I am not talking about any land. I am talking only about the land which is appurtenant to building. Meaning that if I can show you by way of a diagram, it is a building. Okay. So whatever land is there, no, this is a land appurtenant to building. This is some open space, garden type area, parking space, etc. Yes or no? This is what? This is this land which is appurtenant to building, no? This is also your house property because it is a part of your structure only. Sure? Now tell me, what about this is a land and this is a house? Is it a land appurtenant to building? Is it a land attached to the building? This huge land, a small house is constructed. This land has its own identity. It is individual land. Just constructing a house property nearby that land does not make this land as a land appurtenant to building. Getting my point? If this, just imagine if someone comes to buy this house from you, will you sell the house? Yes. With the land, this huge land you will give away. Or you will say that ownership is only for the house. Take the house, land belongs to me. So this land is having its own identity. That land is independent of that structure. Getting my point? So this will not be land appurtenant to building. This is in itself a land itself. Getting my point? Listening or not? Understanding or not? Things are getting inside the mind or going above the head? Inside, no? So whatever I have been speaking in front of you, no, don't worry. Don't worry. See, first point, section 22, basis of charge. The annual value of a property consisting of any building or land appurtenant thereto, of which the assessee is the owner and which is not used by the assessee for his own business or profession, shall be charged to tax under this head. This is something which I already wrote. Written in a good handwriting over here. That's it. Written by me only. But in good handwriting. Okay. Now, see, note number 1. 3 conditions are there. Condition number 1. There has to be a house property. What is the meaning of house property? Come on. Note number 1. A property will be treated as a house property for this head. A property will be treated as a house property for this head if that property is what? Any building or any part of the building or even the land appurtenant to building. Yes or no? Any building means what? It can be residential in nature. It can be commercial in nature. I have given few examples. Then any part of the building is also a building. It is also a house property. Yes or no? What are the parts of the building? Come on. Roof, wall, pillar, etc. Any land appurtenant to building means this land is attached to the building in such a way that it is an inseparable part of that structure. Whenever you transfer the structure, automatically the ownership of the structure along with the land goes away. Land goes away as a part of the building. Hello. If you buy the building, this land is coming to you along with that building. It does not have its own existence. Examples are open parking space is there, garden area is there, okay. One small angan is there in the center of your house. All such lands are known as what? All such lands are known as land appurtenant to building. Done. What if you are giving on rent any open plot of land? There is an open plot of land. For example, you bought some land thinking that you will construct a property on this. But unfortunately, you could not construct a property. That land remains vacant. That land remains open. Now, I am taking that land on rent from you. Will you on rent from me? Yes. Is it your income? Yes. Under which head you will charge this income? Come on, tell me. Can you charge the rent of the open plot? Rent of this land. Can you charge this rent under the head house property? The answer is no. Because in order to charge any rental income under this head, that rental income should come from a house property. And by the way, this rental income is coming from house property. No, it is coming from open plot of land. And by the way, open plot of land is not a house property. House property we have already seen. Any building is there, any part of the building is there, and land is there, then the land should be appurtenant to building. It should not be open plot. It should not be open land. Getting my point? So what if you have let out an open plot of land? Is it a house property? The answer is no. If that is not a house property, the rental income of that land cannot be taxable under the head house property. It will be your income from other sources. But if you are into the business of letting out the land and getting such rental incomes, then this will be treated as your PGBP income. Getting my point? Should I move ahead? Now the second condition is the house property for which we are talking right now, the property which we want to bring under this head, the assessee should be the owner of that property. The assessee should be the owner of that property. What do you mean by owner? That we are going to know. But tell me, assessee should be the owner of the property. What type of assessee can be the owner of the building? Can I say individual can be the owner of the building? Can I say a company can be the owner of the building? Can I say a partnership firm can also be the owner of the building? Any person can be the owner of the building. That means for every person who is the owner of the building, that property will be brought under the head house property only. Getting my point? So, assessee can be any person who is the owner of the building. Do you know the person? Meaning of the person 2 subsection 31? So all the persons which are written in 231, they can be the owner of the building. Yes. Now ownership of the building should be legal ownership. Meaning that ownership, nobody can deny that you are not the owner. How? The title deed is on your name. The registration of property is on your name. That means legally, on paper, you are the owner. So you should be the legal owner of the property. But sometimes it might also happen that you are not the legal owner of the property. But still, the income of this property will be charged in your hands, assuming that you are only the owner. There is a concept of deemed owners that you are going to study with me in section number 27. Last part of this chapter, we will be doing section 27 and the chapter will be over. So that time I will show you, that time I will discuss those cases where you are not the owner of the property. But for the purpose of house property head, you are deemed as the owner of the property so that the income of the property should be charged in your hands. If you are not doing it, no, then there will be problem. The income cannot be charged in anyone's hands. Or there will be some mischief which will be going on. To stop that mischief, we will have to make you the owner of the property. Knowing that you are not the legal owner, still we will charge the tax on the income from you only, assuming that you are only the owner. So that is the concept of deemed owner. So tell me, assessee can be any person, but the assessee needs to be the owner of the property, meaning the legal owner of the property. And sometimes if the assessee is not the legal owner of the property, he can also be deemed as the owner of the property in order to charge tax on the income of that property in his hands. Yes or no? Sure. Now pay attention. Now assessee should be the owner of the property when the ownership is required. Is it required during the assessment year or is it required during the previous year? It is required during the previous year. Meaning that you have a house property of which you should be the owner during the previous year. And if you are the owner of the property during the previous year, the income of that property will be charged in your hands during the assessment year, even if you are not the owner of that property during the assessment year. You cannot argue that the year, assessment year in which the income is getting charged, I am not the owner, so I will not pay tax. No, ownership in the assessment year is not required only. As far as you are the owner of the property during the previous year, the income of that property will be charged in your hand during the assessment year, even if you are not the owner of the property in the assessment year. So when the ownership is required? Ownership is required during the previous year. Getting my point? Now tell me, owner of what? Assessee should be the owner of what? Assessee should be the owner of the house property. Assessee should be the owner of the house property. Assessee should be the owner of the house property. Please repeat. Assessee should be the owner of the house property, not the land on which the house property stands. Not required. You are the owner of the land and on which you have constructed the house property, and you are the owner of the house property also. So the income of the house property will be charged in your hands. Why? Because you are the owner of the both? No, you are the owner of the house property. That's why. Sometimes it might also happen that I have taken a land on a long-term lease for 20-50 years. On that land, I have constructed a house property. Will the income of this house property will be taxable for me? Yes. Even if the house property I have constructed on a land which does not belong to me, I am not the owner of that land, but am I the owner of that structure? Yes. Ownership of the structure is required, not the site on which the structure stands. Even if you are not the owner of the land on which the house property was constructed, still the income of that house property will be chargeable in your hands, provided you are the owner of the house property. Yes or no? Sure. So if the land on which the house property is situated, if it is not owned by you, no problem. If it is owned by you, then also not problem. Not owned by you, then also not problem. The property which is constructed on the land, no, that property must be owned by you. Getting my point? Sure. Now tell me one thing. I'll ask you that Mr. A is there. He is the owner of the property. He has let out his property to Mr. B. And the same property Mr. B has sublet to Mr. C. Letting out the property taken on rent to someone is known as subletting. So tell me, Mr. A is letting out his own property of which he is the owner to Mr. B, from which he will earn rental income from Mr. B. So this rental income is the income of Mr. A, who is the owner. Yes or no? For A, this rental income will be his house property income. But B is also letting out the same property to C, property A only, of which B is the holder now, not the owner. B is the holder now. B is subletting that property to C, and from C, B is also earning rental income. This rental income will not be charged under the head house property in the hands of B. Why? Because B is not the owner of that property. But that does not mean that this income will not be taxable for Mr. B. This income will be Mr. B's income from other source. Or it can be charged under PGBP also, provided it is a business of Mr. B, letting out such properties. Understanding? What if the ownership is in dispute? Can the ownership be in dispute? Yes. So till the time the dispute is not resolved by the court, no, income tax department will decide that who should be treated as the owner. And that is decided on the basis of the fact that who is deriving the benefits out of that property, who has the possession of that property. Till the time the court is not giving the final verdict that who is the owner amongst the disputed parties, who is the owner, till the court is not giving that judgment, no, till that time, still the income will be charged. Even if it is not known that who is the owner. Let the court will decide it after 20 years. So for 20 years, will not charge tax, will charge tax. We'll take that tax on the income. But we'll take that tax from that person who is having the possession of the property, who is deriving the benefits of the property as an owner. Once court decides no, after that, whatever decision court has given, He will be treated as legal owner and from him we will collect the tax. But till that time we will decide. Hello sir. In case of disputed ownership. Done? So first condition is there has to be house property. Did you understand what is house property? Yes or no? Second, the assessee should be the owner of the house property. Did you understand the ownership concept? Sure. Third condition is the house property of which the assessee is the owner shall not be used by the assessee for his own business or profession. Meaning that if the assessee is the owner of the house property and this house property is self-occupied by me and used by me for my own business or profession, that type of house property I will not bring under the head house property. I will have to take this house property under PGBP head. Reason is very simple. See, the property is used by you, exploited by you to earn your business or profession income. The property is used in your business. The property is used in your profession. So the use of the property, exploitation of the property is happening to earn your business or profession income on which you are already paying tax under PGBP head. Now additionally charging tax on the rental value of this property under house property head will be an injustice with you, no? Either we charge the rental income of this property, rent earning capacity of the property, or we charge the business income which this property is by using this property in the business income you are deriving. Either we will charge that business income or we can charge what? The rent earning capacity. That we have to decide. So we have decided that we are going to charge tax on the business income which is derived by exploiting this property in business or profession, and hence we are not going to charge the rent earning capacity of this building under the house property head. Ignore this from house property head. Got it? So if you ask someone that why the house property which is used in business or profession is not covered under house property head, ask this reason, you will come to know that whether they are knowing the logic or not. What is the logic? Why the house property which is used in business or profession is not brought under house property head? It should be brought under house property head, no? Why it is not brought under house property head? The reason is very simple. The exploitation of the house property is happening in the business or profession to earn PGBP income, hello, on which the assessee is already paying tax under PGBP head. Hence, its rental value, its rent earning capacity should not be taxed under house property head. If that is happening, that is an injustice for the assessee. To avoid that, the government is ignoring this property. The lawmakers are ignoring this property from the house property head. Take this property under PGBP head. So tell me, all the other properties which are not used in my business or profession are to be brought under this head, yes or no? So those properties will either be let out by me. Can I let out a property? So if I am the owner of the property, I have let out the property. Am I using that property in my own business or profession? No. So I will bring that property under the house property head. Can I have the property? Am I the owner of the property? Yes. Can I self-occupy the property instead of giving the property to someone else on rent? Can I self-occupy? If self-occupied for my own business or profession, I will ignore. But if I self-occupy for the residential use, for myself and my family members, then I will have to bring that property under this head. Even if I am self-occupying and keeping the property vacant, then also I will have to bring that property under this head. Getting my point? So what if the house property is occupied by the assessee, meaning self-occupied, and occupied for residential use, for self and family, or it is occupied but actually not used as resident but kept vacant, kept reserved, that whenever I want I can use it as my residence, whenever I want I can use it in a way in which I want. Till that time I am keeping it vacant, till that time I am keeping the property reserved for me. Yes or no? So all such properties I am supposed to bring under the head house property, but not this one. I have self-occupied and using in my own business or profession. Got it? Sure. Now coming to the next part. Now this discussion is an important discussion. because there is one amendment in this discussion which I'm going to do with you. First of all, read this chart and try to understand that what you are understanding from here. Come on. I'm giving you 2 minutes to read it. Read it on your own. Did you figure out something? See, I'm having a business. Business means I'm having a factory in which I'm doing manufacturing business. Okay. So that factory is very far away from the city. Very far. 200, 300 kilometers away. Now to run that factory, I need some employees. I need some workers. From where will I get the workers? The workers will come from some city or town, nearby cities and towns. Okay. The workers will be working, the employees will be working in my factory. And just imagine, I cannot expect them to travel every day 200, 300 kilometers. No? And nobody is going to come so far traveling every day. So what I will have to do, I will have to construct some houses over there nearby my factory. So I acquired a huge land. On that land, I have constructed many houses, a small township kind of thing. Yes or no? And in that township, whatever houses I have constructed, of which I am the owner, yes or no? Now I am calling my employees, telling them to work in my factory. Okay. Don't worry, the company will give you accommodation to stay here. Company will give you a house to stay here. See, I have constructed such a big township. In this township, we will allot you one house. You stay in this house with your family. Whatever basic facilities are required, no. School, medical, everything will be nearby only. Supermarket, banks, etc. Every damn single, facility will be provided by the employer in this township. You just come here, work here. And as far as staying is concerned, you stay in our houses which we have constructed in this township. Yes or no? Big companies like Reliance, Tata, who have huge factories and all, they have constructed their own townships like this. So when the employees will come, they will stay in my houses, my properties, of which I am the owner. But don't you think those properties which I will be giving them to stay there so that I can run my business smoothly, those properties are used in my business only? Not directly, but indirectly, those properties are used in my business to keep my employees. And now keeping my employees there, if I charge small rent amount from them, that okay, you are coming here, we are keeping you in our houses, okay, so give some rent to us, give some rent amount to the company, so that normal repair etc. is taken care of. That rent, earning the rent of the property is my intention, or doing my business is my intention. I never got that rent from my employee thinking to exploit the rent earning capacity of those houses. Getting my point? My intention was to run my business smoothly. If I would not have started that factory, I would not have constructed those houses. If those houses were not constructed, employees were not staying over there, I would not get that rent. So to earn that rent, I need to start that business, construct that township, bring my employees over there, let them stay over there and earn this rental income. Rental income is not earned with an intention to exploit the rent earning capacity, but it is done with an intention to run my business smoothly. So whatever rental income is happening to me in this case, no, it is happening in the course of my business only, in the course of my business operations. These properties are given on rent to my employees. Given on rent? No. given to my employees to stay, and as a result of that I am deriving some rent. This rent derivation is not with an intention to exploit the rent earning capacity. Hence, this rent coming from the employees in the course of business or profession cannot be taxed under the head house property. It is my income which I am earning in the course of business activities only, not my main income of the business, but incidental income of my business. This income is happening as a result of doing this business. If I was not doing this business, this income was not happening only. Getting my point? So is it my business income? Yes. So this will be charged under the head PGBP and not under the head house property. So if the assessee is the owner of house property which is let out, and letting out such property is supplementary, meaning helping, and as a result of doing a business of the assessee. Supplementary and incidental. Supplementary means as a result of. Incidental means as a result of doing the business. Then whatever rental income I am deriving by letting out such house properties will not be taxable as my house property income, rather it will be taxable as my PGBP income. Will you remember this example of this factory? Sure. Now tell me, what if I am the owner of a house property and the house property is let out, and letting out the properties happens to be the main business activity only for myself? See, people do business activities, various type of business activities. I can have a business activity of buying and selling this pen. I can have a business activity of buying and selling clothes. I can have a business activity of giving some equipments on rent. And at the same time, I can have the business activity of buying the properties, giving them on rent and earning the rental income. If I prove that giving the properties on rent and earning rent is my business, then whatever rental income comes is my PGBP income and not my house property income. Getting my point? So, there was a case which happened long time ago. The name of that case was Chennai Properties and Investments Private Limited. In that case, what happened? This company was there. Name of the company was Chennai Properties and Investments Private Limited. What was the main business of the company? The main business was to acquire the properties, give the properties on rent and earn the rental income. With that intention, the company started. Main business of the company was this only. And this was proved by looking at their memorandum of association. MOA, na? So whenever a company is formed, there is MOA, in which name clause is there, situation clause is there, one very important clause, object clause. With what object the company is getting formed? Third clause, object clause. So in that object clause of the company, it was written, the company is formed to do the business. What type of business? Acquiring the property, giving them on rent and earning rental income. This was written in the memorandum of only. Now, whatever main business activity written in your memorandum, from that business activity, if you are earning a rental income, earning an income, how can that be treated as your house property income? That has to be treated as your PGBP income only, no? If that income is getting charged under house property head, knowing that it is a exploitation of rent earning capacity, earning the rent, there is one head and it can go to house property head, but still it cannot be taxed under house property head, because if it is taxed under house property head, what income that poor company will charge under PGBP head? Because that is the main business only. The main business income only, you will tell them to classify under house property head, then what income this poor company will charge under PGBP head? Getting my point? That was the observation of the Supreme Court. Supreme Court judgment I am discussing with you. So Supreme Court says that no, assessee is correct. This income will be charged under the PGBP head for the assessee and not the house property head, even if rent earning capacity is exploited. Even if there is separate head to charge such income under that head, house property, still it will not go under house property, it will come under PGBP. This judgment was there. Whenever Supreme Court gives a judgment, no, that judgment becomes law of land. Whenever Supreme Court gives a judgment, that judgment becomes law of land, meaning that judgment itself becomes a law. Now, what is a law? If your business is to give the properties on rent and earning the rental income, and if you can prove that thing, that it is your business to give the properties on rent and earning the rental income, then that income will not be your house property income, that income will be your PGBP income. Now in India, after this judgment, everyone became a businessman. Everyone started telling that this property rental income which is coming, no, that rental income, my business is to earn this rental income. See, Chennai Properties and Investment, Supreme Court judgment saying that this will be my PGBP income. Everyone started saying that. Why, Because when you charge such income under the head PGBP, you get many deductions, and after taking those deductions, whatever resulting income remains, that is very less for the purpose of taxability. But if you charge that income under the house property head, very limited deductions are available. That means the taxable income which remains after claiming the deduction is higher as compared to PGBP head. That means you are supposed to pay more tax if the income is charged under house property head. Getting my point? So everyone started doing like that. Even person like me having 3-4 properties, all are residential properties, I am letting them, I am earning rent, and I am charging that rent under the head PGBP. And if the department is asking, I am saying that it is my business to let out the property. I have just now started from this year only. Hello. So to stop all such bullshit, this year one amendment came in PGBP head. This year one amendment came in PGBP head under section 28. 28 is a charging section, because 28 is the first section of PGBP head, that is a charging section of PGBP head. There was one explanation which got introduced this year, explanation number 3 to section 28. And as per this explanation, even if your business is to let out the properties, the rental income earned by you will not be taxable under PGBP as per Supreme Court judgment. It will be taxable under house property income, house property head only, if the properties let out by you are residential in nature. So if you are into a business, you are saying that you are doing the business of letting out the properties, no? And your properties which you are letting are residential in nature. No matter what, from this year onwards, the rental income of this residential properties can never be treated as PGBP income. They have to be charged under the head house property, even if it is your business to let out such properties. But since the properties are residential in nature, the rental income we cannot charge under the head house property. Sorry, we cannot charge under the head PGBP. The rental income will always go for house property head. Supreme Court judgment effect nullified by introducing this explanation. And this explanation was inserted only for those properties which are residential. Meaning that currently Supreme Court judgment is partially applicable for commercial properties. If the business is to let out the properties, commercial properties, and rent is earned, then that rental income will be charged under the head PGBP by applying the Supreme Court judgment. But if the business is to let out the residential property, whatever rent is coming cannot be charged under PGBP head. Charging section of PGBP head has excluded that from this year onwards. So where it will go? It will automatically come to house property head. Got it? Everyone? So what if my business is to let out the properties, earning the rent? That rental income will always be my house property income if the properties let out are residential. What if my business is to let out the property and earning the rent? That rental income will be my PGBP income if the let out properties are commercial in nature. That's it. Sure? Now, what if in the course of doing my business, I am giving some properties to my employees and earning a small amount of rent from them? This will also not come under house property. This rental income is the incidental income happening as a result of doing this business, will be taxable under the PGBP head only. Why I am telling you all these things, examiners try to put you in trouble by introducing small adjustments like this in the main question. if one income he is giving you, they are telling you to compute total income, PGBP income. In that PGBP income, one small adjustment like this they have given. If you are not aware about this thing, no, unnecessarily the income which you are supposed to charge under PGBP head, you will charge under house property. Or the income which you are supposed to charge under house property head, unnecessarily you will charge that under PGBP head. If you are not aware about these things. So ultimately your answer will be wrong only. So you are supposed to take the informed decision. Okay, this was the provision. With this provision, I will check what is happening. What is happening? Try to recollect this thing. You will automatically get the answer. What is to be done here? Understanding? Shall I move ahead? Now pay attention. Now, next one. See, if you are a partner in a firm, okay, Akshaya is a partner in a firm. Akshaya and myself, we both are partner in a firm. Akshaya is the owner of a house property, owner of a property. For example, Akshaya is having an office. So she is the owner of that office. She is saying, sir, let us use my office in our partnership business. And for that, I will not charge any rent from the partner. I will charge rent from the partnership firm. Because see, anyways, we would have taken the office on rent from someone else. So in spite of taking the property on rent from someone else, office from rent on someone else and giving them rent, why should not myself earn that rent from our firm? I said, okay, no problem. So Akshaya is the owner of a house property. She happens to be the partner in a firm. The house property of which she is the owner, that house property she has given on rent to the firm in which she is the owner. She cannot say that I am using that property in my partnership business. Hence, this property is not to be considered under house property head. She cannot say that. Why? Because she is earning rental income from that property. She is exploiting the rent earning of that capacity of that property, earning the rent of the property. For her, this property is her let out property, which will be covered under house property head for her. Even if she is giving that property on rent to that partnership firm where she is a partner, she cannot say that I am using that property in my own business, in my partnership business. I will not bring this property under the head house property. She cannot say this. She will have to bring the property under house property head because she is earning the rental income out of that property. See, the partnership firm is paying her what? Rent. Because the house property of which she is the owner is let out to the firm. If she would have let out this property to someone else, this rental income she would have to show under the house property head only, no? Then why not now? Now also this rental income will be shown under the head house property. Yes or no? But on the contrary, let us twist this example. Now that same house property she has given, she has given to the firm. She has given the firm, not let out. She has given the same house property to the firm, saying that let's use this property in the business. And for that, she is not charging any rent also from the firm. Now, in this case, it will be assumed as if she is using that property in her own business or profession. And accordingly, this property she will not show under house property head. Why? Because this property is used by her in her own business or profession. Partnership firm is as good as her own business or profession only. Yes or no? So will you remember these notes, everyone? Very, very, very important discussion. Very important discussion. Okay. Now last one. Amount taxable under the head house property. If all the three conditions are getting satisfied, which we have discussed so far, there has to be a house property. The assessee should be the owner of that house property, and that house property should not be used by the assessee for own business or profession. If all the three conditions are fulfilled, no, bring that house property under the head house property. Now, when you are bringing the house property under this head, what will be taxable? What will be taxable? Annual value of that property will be taxable under this head. What is the meaning of annual value? Rent earning capacity of the house property, not the rental, actual rent. No, not the actual rent, rent earning capacity. So that rent earning capacity shall be determined as per section 23, and as per section 23, whatever rent earning capacity has been determined, no, that rent earning capacity will be the income of that property which will be chargeable under this head. But don't worry, from that income we will give you some deductions also, which are given in section number 24. So the deductions you will take from the annual value, the income which is chargeable under the head from the property, this income is chargeable, annual value, and from this annual value we will allow you two deductions under section 24. Take those deductions, and whatever balance remains, that is the taxable income of this property. And that you are supposed to do, this exercise you are supposed to do for all the properties which are classified under this head. You have 5 properties. How many? 5, of which you are the owner, and you are not using any of those properties in your business or profession. Yes or no? Bring all the 5 properties under this head. First property, annual value minus section 24 deductions. You will get final income of first property. Second property, calculate annual value. Take section 24 deductions. Yes or no? You will get the final income of second property. Likewise, do it for all the properties. Now you have final income of all the 5 properties. Add all of them. There will be a single amount, that is the income of this head. Income of house property head. Income of house property head will come after considering all the sources, calculating income of all the sources, and adding the income of all the sources together will give you one figure, that is known as house property head. Getting my point? So for every property, how the income will be calculated? Computation of taxable income of any house property. How that will be calculated? First, you are supposed to determine the annual value, meaning gross. That annual value which you will be determining, no, that will be a gross amount. But from that, you will be given a deduction for municipal taxes which you have paid. So there are some municipal taxes of the property which you might have paid during the previous year. Take the deduction for those municipal taxes, because ultimately the municipal tax will go out of the rental income only. Rent earning capacity you have exploited, out of that only you will be going to pay what? Municipal taxes. Take the deduction. Now whatever annual value remains, that is the net amount of annual value, on that you are supposed to pay tax. But don't worry, from that, after taking section 24 deductions, no, whatever balance remain, that is only going to be the taxable income. Yes or no? So first what you will calculate? Gross annual value. All the properties. What you will calculate? Gross annual value. Then from that, you will take municipal tax deduction. You will have net annual value. What you will have? Net annual value. And from that net annual value, you will get two deductions under section 24. 24 clause A, standard deduction at the rate of 30% of NAV. And clause B is interest on housing loan. Clause B is interest on housing loan. That will be allowed as a deduction. Yes or no? So two deduction. After taking these two deductions, whatever remains, no, that is the final taxable income of that property. For every property falling under this head, you are supposed to do the same calculation. First calculate annual value, GAV, municipal tax, NAV, take two deductions, final income. Calculate GAV, municipal tax deduction, NAV, section 24 deduction, final income. Do it for all the properties. Now, all the properties final income you have got, add all of them, you will get taxable income under the head house property. This is the final income of this head. Done? Now, how to determine this GAV? First, we will understand this, because this GAV calculation is different for different types of properties, and that we have to learn by looking at section number 23. Everyone, once we determine the annual value, then rest of the process is same for all the properties. But calculation of GAV is different for different types of properties. Yes or no? This type of property, this will be GAV. Okay, property is some other type. Okay, so for that type of property, GAV should be calculated like this. Oh, property is any other type property, third type of property. Okay, for third type of property, GAV will be calculated like this. So different types of property, different GAV will be there. Okay, but after GAV, the process is same. Minus municipal tax, NAV minus two deductions. Done. So this will be common for all. This part will be common for all. But GAV calculation is different for different types of properties. Yes or no? So whatever GAV computation is there, that we are going to study now under section 23. Okay. So section 23 has 5 parts. How many parts? 23 has 5 parts. 23.1, then 23.2 is there, then 23.3 is there, then 23.4 is there, and then last but not the least 23.5 is there. Okay. Now what we are going to do, please pay attention. Please pay attention. See, whatever type of properties you are having, no, first of all, ask yourself, do you have a house property during the previous year? Do you have a house property? Are you the owner of that property during the previous year? Have you used that property for your own business or profession? No. All the conditions are fulfilled. Bring that house property under house property act. Now the annual value of this property will be charged. Okay. How to determine the annual value of this property? So first I will have to categorize my house property into these 5 parts. So whatever property which I have brought under this head, no, either that property will come in 23.1 or it will come in 23.2 or it will come to 23.3 or it will come to 23.4 or it will come to 23.5. There cannot be any other category. All the categories are covered. Whatever property you will be having, no, give me the example. We will be classifying any damn single property into these 5 categories only. There is no other category other than this. All the possible categories are covered. 1. The property which you are having either can be let out or it can be self-occupied. Yes or no? If self-occupied for business, will it come here? No. So there is no category for self-occupied property for business. Yes or no? Because that property is not coming here only. So whatever categories are there, in these categories, we are going to learn if the property is let out or the property is self-occupied. That's it. What if the property is let out? Come on, tell me. What if the property is let out? Then that property is covered under 23.1. Property is let out. We call it LOP. Let out property. LOP. Understood? Now pay attention. Whatever property you are having of which you are the owner, if that property happens to be your let out property, no, tell me, have you given the property on rent and earning the rent? Meaning that your property has a rent earning capacity which you are exploiting, and by exploiting that rent earning capacity, are you earning rental income? Yes or no? This rental income is nothing but rent earning capacity exploited. Rent earning capacity exploited and coming in your hands now. Should it be taxable or should not be taxable? Taxable. So let out property will have rent earning capacity, and this rent earning capacity will be taxable. Now how to determine this rent earning capacity? As per 23.1. Can you see this table? This is the way in which the rent earning capacity, meaning the annual value, meaning the GAV of the let out property will be calculated. And once it is calculated, 23.1 says it will be calculated like this, and then it will be taxable under the head house property. Sure? So now pay attention. How to determine this? We'll learn, don't worry. Second type of property, 23.2. Can I say a property, if not let out, it will be self-occupied? Hello? So we call such properties self-occupied properties. Will this property have any rent earning capacity? Can this property earn rent for you? Yes, it has the capacity to earn rent. But you are not exploiting that capacity and earning the rent. See, for let out property, that property has a rent earning capacity which is exploited and rent is earned out of that. But self-occupied properties also have rent earning capacity. But since that rent earning capacity is not exploited to earn actual rent, no, hence the rent earning capacity is exempted. What did I say? Does this property have rent earning capacity? Yes. But is the rent earning capacity exploited and actual rent is earned? No. So government is saying that in spite of charging tax on that rent earning capacity, which is not exploited as rent, why not to exempt it? Exempt it. Because it will be bad for the assessee, no? Knowing that the property can earn rent, which he is not earning, charging tax on that rent will not be good for the assessee. Because if we start charging tax on that annual value, if we start charging tax on that rent earning capacity, what will happen? That poor assessee will take him out of his own house, start staying on the bus stand, start staying on the railway stations. Why are you staying on your railway station if you have a house? That poor fellow will say, I'm not staying out of my own wish. I have to stay here because the government is very bad. I'm staying in my own house, hence I'm not able to exploit the rent earning capacity, but still the government is charging tax on that rent earning capacity, earning nothing and paying tax on that. That is not better. Hence I've given that property on rent so that I can earn income and pay tax on that income. Knowing that I have own house, I cannot stay in my own house. Getting my point? Hence the government is saying, don't worry, we are not that bad people. Come on. The property which you are using for your own residential use, the annual value, the rent earning capacity cannot be exploited in the form of rent. No, don't worry, we will not charge tax on the rent earning capacity of such properties. Assessee became very happy. Wow. So if I start calling my property as SOP, the government will not charge tax on my annual value. Now the assessee is calling all his properties as SOP. Even those properties which he has actually let out. So giving the exemption for all the SOPs will be dangerous. Yes or no? So the government has put a restriction. What the government is saying, that out of all the SOPs, the annual value will be exempt under section 23(2) for any two SOPs. And the option to take that exemption is given to you. You decide which two SOPs annual value is exempt. But other properties which you are treating SOP, their annual value will not be exempted. They will be deemed to be your let out properties. Deemed let out as per 23(4). DLOP, known as deemed let out properties. Yes or no? And their annual value will be calculated also, and it will be taxable also. Don't you think? Wait. Pay attention. Pay attention. These are those properties only which are not giving you rent, but still their rental value will be charged to tax. You have 5 SOPs. Any 2 SOPs, annual value claim as exempt. What about the balance 3? They are SOPs only. The annual value is not earned, but still they will be treated as deemed let out and tax will be charged. Imaginary income is charged to tax, which you are not actually earning. Why it is done? Because this might not be imaginary income. You are trying to show that this is SOP, but maybe it is let out property and you are earning this much rent and you are not offering for taxation. So at least we'll have tax on this much rent earning capacity, no? Or even if they are not actually let out, knowing that these properties can earn this much rent, why are you keeping them idle? Give them on rent and start earning this much rent. Keeping them idle, hello, creates a demand supply gap in the market. Because of people like you who are keeping your property idle, these properties are not going in the market to be let out. Hence, as a result of that, what is happening? The Rents are increasing day by day. So if people like you will be charged tax on this notional value, no, what you will do? You will not waste the rent earning capacity. Now the property will come out of your hand and you will start giving the property on rent. Just imagine if you are an owner of a property, that property you are not earning any income. But the government is saying that this property can earn 3 lakh rupees of income in a year. We will charge tax on this 3 lakhs. Are you earning 3 lakhs? No. But the government is saying 3 lakh can be earned, pay tax on this 3 lakhs. Now, however rich person you are, no, it will pinch you. Paying tax on 3 lakhs, knowing that this 3 lakh you have not earned. Getting my point? So it is always better to earn 3 lakhs and pay tax on 3 lakhs, no? Now this property automatically which was kept by you, you are not exploiting the rent earning capacity, not letting out the property, no, that will come out. And you will put the property in the market for rent. Now you will start earning the rent. 3 lakhs or maybe more than that. And now you will also like that, okay, income is earned, on that I am supposed to pay tax. But this happens only if we start charging tax you like this. If we start charging tax with from you like this, getting my point? And by doing this, what will happen? 3-4 properties from your hand will come in the market. So demand will be met because now the supply is increasing. Getting my point? Now tell me, out of 5 properties, any 2 properties can be treated as SOP and its annual value can be exempted. Yes or no? Which 2 properties? Any 2 property. Option is given to the assessee. So assessee, which 2 SOPs you would like to claim exemption? Which 2 properties you would like to claim exemption? Come on, tell me. So definitely those properties which are having higher rent earning capacity. The properties which are having higher annual value, higher rent earning capacities, I will claim exemption for those 2 properties. And remaining property having a lower rent earning capacity, having a lower annual value, I will show them deemed let out properties. That will be better for me. But giving you exemption for all SOPs is not something which the government wants to do. Government will give you exemption only for 2 SOPs. Rest all the SOPs you have to treat as what? Deemed let out property. Their annual value will be calculated and on that you are supposed to pay tax also. Now please pay attention. Can I say self-occupied properties, no? You are not bothered only to calculate annual value. Why? Because even if you will calculate, that is going to exempt only, no? You are going to take that annual value nil only, no? So don't bother yourself to calculate that annual value. Take the annual value nil for 2 SOPs. Yes or no? But what about those SOPs whose annual value could not be exempted? You will now start treating them DLOP. Now their annual value will be taxable. Yes or no, friends? How to calculate this annual value? In the same manner in which you calculate the annual value for let out properties. So if you know let out, you know deemed let out. Hello? But the only difference will be for let out properties, there will be actual rent because that is actually let out. And for them, there will be no actual rent. Some imaginary amount will be treated as your rent earning capacity. That will be charged to tax. Getting my point? There for let out property, some imaginary amount or actual rent, whichever is higher will be your rent earning capacity. But here, an imaginary amount without any actual rent will be treated as your rent earning capacity. Understood? Now 23(3). What this property is? Partly let out and partly self-occupied property based on time. Partly let out and partly self-occupied property based on time. Sir, what is the meaning of this, sir? Please pay attention. See, I would tell you one thing. First of all, digest this thing, whatever I am trying to tell you. A property can be treated as SOP. A property can be treated as SOP only if it is of any of these three types. So three types of properties I am telling you. If you see any of these types of properties, no, only these types of properties can be treated as SOP. Yes or no? First property, listen to me carefully. Throughout the year, used for residence. Are you earning anything from this property? No. Throughout the year, you are using for residence. No. Your residence or your family members' residential purpose, the property is used throughout the year. Are you earning anything from this property? No. Call this property SOP. This can be treated as SOP. Yes or no? Throughout the year, property kept vacant, kept reserved, that whenever I want, I can use. Did you earn a single rupee? This property can also be treated as SOP. Done? Part of the year you have used as self-occupied, used for residence, and the balance part, it was kept vacant. You could not occupy because you got shifted to some other place due to your employment, due to your business, due to your profession. You have to shift to some other place, some other city. Hence, this property could not be occupied for the balance period, but it was kept vacant. No money was earned. Part of the year used as residence, balance part of the year kept vacant because of reason that you are shifting out, shifting away. But for that period, you kept vacant. Did you earn anything? So throughout the year, have you earned anything from this property? No. Initial phase, you were staying, so could not earn. And the later on phase, it was kept vacant, you did not earn. Even this kind of property can be treated as SOP. So if your property is of any of these three types, no, only then call your property as SOP. The moment you start taking the benefit, moment you start earning something out of your property, the property does not remain SOP anymore. Getting my point? Not PGBP, Akshaya. What do you say? How come PGBP? Forget PGBP. It is not PGBP. Ayyo. We are talking about those properties. We are already under house property head. So whatever we are talking only about house property head now. Getting my point? Now tell me. Oh, sorry. Then it is okay. I thought because something happened here, so I thought that you just sent right now PGBP. So did you understand this thing? Now pay attention. Wait. So now tell me, how many SOPs? Listen to my question very properly, then answer me. Huh? Don't jump to any answers. How many SOPs I can have? See, any of these three types, SOP can be any of these three types. How many SOPs I can have? You did not listen to my question properly, Akshaya. How many SOPs I can have? Multiple SOPs. But all those SOPs will be only treated as SOP if they are any of these three types. Yes or no? Throughout the year, used for residence. Throughout the year, kept vacant. No money earned. Yes or no? Part of the year, used as resident. Part of the year, kept vacant. Any of these three types, I can call as SOP. So how many properties I can have as SOP? Multiple properties I can have as SOP. Out of them, only two SOPs. Any two SOPs I can claim as exempt. My question was how many SOPs I can have. But out of them, how many SOPs annual value I can exempt? Any two. What about the remaining SOPs? Those will be treated as DLOP under 23(4). Sure, sir? Sure? Now tell me, if you have a property, 1st April, from 1st of April 2024, the property was let out. So the property was let out since the very beginning only, yes or no? And it remained let out till 31st of December. So can I say from 1st April till 31st December, the property is what? Let out. And it is let out for how many months? 9 months. And now tenant vacated the property on 31st December. You started occupying the property, self-occupied the property from 1st of January 2025 till 31st March 25 of the previous year. You self-occupied the property, and that is 3 months. Possible or not possible? Now tell me, what could be the status of this property? But before that, remember one thing, one property or part of the property, can have only one status in a previous year. It cannot have double status. So one property which is let out for some time, self-occupied for some time, can you give two status in this year? No, you have to give only one status. What status you will give to such property? SOP you cannot call only. Throughout the year used for residence or only 3 months? Only 3 months. Throughout the year kept vacant? No. Single month not vacant. Sometime it was occupied by my tenant and sometime I am occupying. It is not vacant. Oh, part of the year self-occupied and part of the year kept vacant. No, part of the year I have taken economic benefit out of the property. I cannot treat such property as SOP. Forget about everything. Because those 3 types, this property does not fall under any of those 3 types. So I cannot give the status of SOP to such property. And remember, one property or even the part of the property. What did I say? One property or even part of the property for a single year, it will have only one status. And if I have to give one status to this property, the status cannot be SOP. It has to be LOP because I've started earning the income out of this property. Got it? This is 23(3), partly let out, partly self-occupied based on time. Sometime let out, sometime self-occupied. So part of the year let out, part of the year self-occupied. Based on time, it is partly let out, partly self-occupied. So 23(3) says that this property cannot get what? Tell me, double status. It will have only single status. And what single status is suitable for this type of property? 23(3) says that only one single status can be given to this property, and that is LOP. So, did you understand? Yes or no? Do you know how to calculate the annual value of LOP? Yes. Like that same way, the annual value of this property will be calculated. Because the status given is LOP only. So you have to learn that how to calculate the annual value of LOP. Then this is a piece of cake for you. Very easy. SOP you don't have to calculate only because 2 SOPs annual value will be exempt. But what about the SOPs in excess of 2? That will be DLOP. No sir. For them also you are not supposed to worry. If you know LOP, DLOP is same way in which we are supposed to calculate LOP. Hello sir. Easy or not? Made easy. Say thank you. Okay. Now last, fifth. What is the fifth type? 23(5). I will keep it in suspense right now. Keep it pending. I will not have any discussion about it. Otherwise, you will, get confused. So broadly speaking, we are supposed to calculate the annual value of lettered property only. We have to learn that. If we learn that, no, automatically we will learn 23.3, partly lettered, partly self-occupied based on time. Automatically we will come to know DLOP also. Sure? Because it will be copy paste only. Few small minor changes, those will be very comfortably, sailed out. But very minor change. Now tell me one thing. Is it possible that there is one property with you? I'm not talking about 23.5. 23.5 I will not discuss right now. Later on I will discuss. That property has ground floor and this is first floor of the property. Can I have such property? Single property I am having, but that property has two parts. Part of the property. Part. First floor, I am staying there. Self-occupied. And the ground floor, no, I gave on rent. Ground floor I gave on rent to Kanu. I am having one property. Some part of the property is self-occupied and some part of the property is self-occupied. Now, please apply some logic and you only tell me. This entire property will have a rent earning capacity. Entire property. Ground floor, first floor, entire property will have a rent earning capacity. Will you pay tax on the entire rent earning capacity? Would you like to pay tax on the entire rent earning capacity of the full house? Why not? Because if the entire rent earning capacity of the full house is charged to tax, that means the rent earning capacity of that portion is also getting charged, which you are not earning. You will not like it, no? So do one thing. Rent earning capacity of the entire house, claim exempt. Will the government like it? Because the rent earning capacity of the let out portion, you are exploiting and earning the rent, no? So the government will not like it. So what is the solution here? Do one thing. Divide the properties into two parts. Let out part, separate property. Self-occupied part, separate property. Annual value of self-occupied part can be claimed as exempt if that is the only SOP. Or one SOP was already there, this will be second SOP. If already two SOPs are there, this will be third SOP, this will be treated as a DLOP. Hello, sir. But what if you have separated the let out portion? Are you exploiting the rent earning capacity of this let out portion? This will be treated as a separate property. Let out portion of the house property will be treated as a separate property. Its annual value will be calculated and will be taxable. That's it. This is partly let out, partly self-occupied based on area. Based on what? Area. How to determine the annual value of this entire property? Entire property, one annual value, exempt. Entire property, one annual value, taxable. No! Divide the property into two parts. Both the parts will be treated as separate property. The part which was let out, only the annual value of this part will be taxable, as if the property is let out, as if the part is let out property. Yes or no? The annual value of the self-occupied portion will be treated as a separate property. The annual value of this can be either exempted as SOP under 23.2 or it can also be treated as DLOP if already two SOPs were claimed as exempt. So this will become the third SOP. Getting my point? So now we will learn all these properties, calculation of annual value of all these properties one by one. Sure. So are you finding the chapter interesting? Very interesting and very easy also. If you start the calculations, no, you will solve the questions before me only. The moment I'll start the question, no, majority of the questions you will only start and you will only complete before me only. So that we are going to do. Don't worry. Okay. So now moving the discussion ahead. Okay. let out properties. LOP. How to determine annual value, and after determining annual value, how to determine the taxable income. Any let out property. For all the let out properties, you are supposed to do like this only, which we are going to discuss now. Okay. As per section 23(1), which says that you have to first take the municipal value of the property, MV. MV means municipal value. Then compare the municipal value with fair rent of the property. FR means fair rent of the property. When you compare them, whichever is higher, meaning higher of A and B, usually that is the expected rent which your property can earn. So first of all, municipal value, second is fair rent, take the higher. This higher amount will be restricted to the extent of standard rent. To the extent of standard rent. Now what you are supposed to do, this higher amount and standard rent, whichever is lower of C and D, finally this amount will be treated as your expected rent of the property. This is a notional amount. Notional amount means imaginary amount. So the government is saying, the law is saying that if you are letting out a property, after letting out the property, your property can earn this much amount of rent annually. This is what we are expecting your property to give you. So within a year's time, your property can earn this much amount of rent. This is our expectation from your property. Now, since you have let out the property, no, you might have earned the actual rent, no. Now your actual rent will be compared with our expectation. See, if you are earning more than our expectation, no, that means the rent earning capacity of the property is higher than what we expect, which you are exploiting in the form of actual rent. Your rent earning capacity of the property is your actual rent only, because it is higher as compared to the expected rent. Yes or no? But if your actual rent which you are earning is lower than the expected rent, then friends, whatever we are expecting from your property is the minimum expectation which we are having. This much at least your property can give you. This is the rent earning capacity of your property. So whatever you are earning as rent is lower than this, no? Meaning that you are trying to hide something from us. Actually, you are earning more, but showing us less. Less than the least amount which we are expecting is not acceptable. Either you are trying to hide something from us, or you are a fool. Your property can give you this much, then why are you earning less than this? So in that case, the rent earning capacity will not be the actual rent which you are earning, but the expected rent which we are expecting. So now this expected rent will be compared with actual rent. And on comparing these two figures, what will be there? It will be your GAV, gross annual value, which is nothing but the rent earning capacity. What will be the rent earning capacity? Come on, tell me. Your actual rent will be the rent earning capacity if you are earning more than our expectation. But our expected rent means our expectation will become what? The rent earning capacity if you are earning less than our expectation. Meaning expected rent or actual rent, whichever is higher, will become the GAV. But that is possible only if there is no vacancy in the property. Then only you can, compare both of them and say whichever is higher. Because expected rent will also be for the full year and the expected rent will be also for the full year. Okay, then only you can do this calculation, whichever is higher. But what if there was vacancy of 4 months? Can there be a vacancy of 4 months? Yes. And as a result of that, actual rent will be only for 8 months. How can you directly compare a figure of 8 months with 12 months and saying whichever is higher? Definitely expected rent will be higher in majority of the cases. Getting my point? So in that case, how to determine your GAV, that we are going to discuss. Don't worry about that. Whenever there is vacancy, what to do that time, that we are going to discuss. But first of all, let us have a better understanding of this entire calculation first. See, this figure, no, actual rent, the figure of actual rent, this is known to you, that you are going to show to the department that you are actually earning this much rent. Yes or no? But the law says that the actual rent which you are earning and showing as taxable income, no, that cannot be directly relied upon, because you can hide many things from us. You cannot actually say how much you are earning. You might have earned more, but you are showing less. So there has to be some benchmark with which your actual rent can be compared with, so that we also come to know that whether you are telling us the truth or you are trying to hide something from us. So that benchmarking is done with this, expected rent. Now tell me one thing. You have one property which you have let out. Okay. The monthly rent was 20,000 and you have let out that property for 12 months. So you are saying that your monthly rent 20,000 into 12, your actual rent is 2,40,000. Yes or no? Forget about this 2,40,000 for a while. Before relying on your 2,40,000, they will be setting up a benchmark that how much your property can actually earn, if it is let out for the full year. That is what we will expect, that your property should at least give you this much amount. Now you will compare it with your actual amount. Your property should give you at least this much and you are earning this much. Now that will be compared. Getting my point? Now wait, please pay attention. To calculate this benchmark value, to calculate this expected rent, what they will do, they will first go to the municipality under whose jurisdiction your property is there. So for example, if I'm staying in Ahmedabad, okay, so my property is in the jurisdiction of Ahmedabad Municipal Corporation. Yes or no? If you are staying in the jurisdiction, your property falls in the jurisdiction of Chennai. So Chennai Corporation is the municipal authority, is the local authority under whose jurisdiction your property is falling. Yes or no? Different local authorities, under the jurisdiction of any local authority, your property will come. Yes or no? Now that property, that local authority will charge their municipal taxes on the annual benefit value of your property, which they will be calculated. Meaning that even they charge municipal taxes from you. Who will charge municipal tax? The local authority under whose jurisdiction your property falls. So they will charge municipal taxes from you. To charge those municipal taxes, they also calculate the annual benefit value of your property as per their own rules. So every local authority will have their own rules. By following their own rules, they will be determining the annual benefit value of your property, so that on that annual benefit value, they can charge municipal taxes from you. Tell me, central government will first believe you or they will first believe the municipal authorities? Definitely municipal authorities. Because you can lie to us But the municipal authority will not lie to us, no? As per the municipal records, as per the municipality, if they are charging their municipal tax on an annual benefit value of your property, which they are calculating, they will not be calculating that value biasedly. So before relying on your actual rent, we will go and check what is the municipal value of your property. Municipal value is the annual benefit value of your property according to the municipality, on which they charge what? Municipal tax. For charging their municipal tax, they will not calculate value which is, calculated biasedly, which is calculated wrongly. So they are following proper procedures to calculate their municipal value. So what is municipal value? Municipal value is nothing but according to the municipality, according to the local authority under whose jurisdiction your property falls, according to them, what is the total benefit value of your property for the full year. So according to the municipality, your property can give you this much benefit. On this, you are supposed to pay this much municipal tax. So first, reliance will be put on that municipal value. Now we will come in that locality where your property is situated. Where is your property? See, in Chennai, no, there are many areas, right? No, Anna Nagar is there, Nungambakkam is there. Then what do you say? Many other areas are there. T Nagar is there. Okay, different localities are there. So all these localities are there. Everywhere the rent is not same. 2 BHK flat, if you go and buy, if you go and take on rent in Nungambakkam, that is different rent. Same type of 2 BHK rent, if you will go and buy, go and take on rent in T Nagar, no, it will have a different rental value over there. So we will see that assessee, where is your property situated, in which locality. In that locality, there will be properties similar to your property. You are not the only person having a 2 BHK flat in Anna Nagar. Hello. Other persons are also having 2 BHK flats in Anna Nagar. So what is the normal rent value? What is the fair rent value which is existing in the locality right now? At what rent 2 BHK flats are available in that locality? We can expect that rent for your 2 BHK property also. Hello. So fair rent is what? It is the rent of the similar property in the same area where your property is also located. That will give us a proper idea that what rent is prevailing in the market right now. So before even asking you, we will check the market rent also. That is known as what? Fair rent. So according to us, from your property, how much you are earning, how much you can earn. The value which the municipality thinks annually, or the rent which is prevailing in the market, whichever is higher. According to us, you should be earning this much amount from your property. Either the municipal value or the fair rent, whichever is higher, that amount according to us, you must be earning from your property. But see, there are certain states where the Rent Control Act also gets applied. So Rent Control Act of a state restricts the owners to charge excessive rent from the tenant. Yes or no? So might be your state will be having some Rent Control Act, and as per the Rent Control Act, your property is also getting covered under the Rent Control Act, and your property has some standard rent. Standard rent means this is the amount of rent which the owner can maximum charge from the tenant. That means there is a restriction on the rent amount as per the rent control of the state, which the owner can charge from the tenant. So maybe your property is also subjected to standard rent. Maybe there is a restriction of some rent on your property also, that restriction is nothing but the standard amount of rent fixed by the Rent Control Act. So we will make sure that whatever expectation we are having, no, higher of municipal value and fair rent, that expectation does not go beyond the standard rent. We will restrict our expectation to the extent of standard rent, not beyond that. So higher amount or standard rent, whichever is lower, that will be our final expectation. That is the minimum amount your property can earn for you. Hello. What is standard rent? Standard rent is nothing but the rent fixed by maximum amount of rent which is fixed by the Rent Control Act of our respective state, which the owner can ask to pay to the owner can ask from the owner can ask from the tenant. Yes, owner can ask from the tenant. Okay. Now pay attention. Pay attention. If the municipal value is 3 lakh rupees, in our example, if the municipal value is 3 lakhs and the fair rent was 3,60,000, tell me which is higher? 3,60,000. So the government will expect that you must be earning how much? You also must be earning 3,60,000 only. But fortunately, there was Rent Control Act and your property was subjected to a standard rent. And as per the Rent Control Act, the standard rent fixed for your property was only 3 lakhs. So we will not allow our expectation 3,60,000 to go beyond 3 lakhs. That means 3,60,000 or 3 lakhs, whichever is lower, we will take the standard rent amount as our expectation. That's it. So what will be the expected rent? 3 lakhs. What if the standard rent was rupees 4 lakhs? Then anyways, we were not expecting more than 4 lakhs. No, we were expecting only 3,60,000. Hello? Getting my point? So in our example, for example, if the standard rent was rupees 3 lakhs, so 3,60,000 or 3 lakhs, whichever is lower. Can I say expected rent is 3 lakhs now? This is the minimum amount which your property can fetch as rent for you. This is what we expect that you should also earn from your property. Now tell us how much you are earning. Lower than this cannot be accepted only. Why? Why? Either you are trying to hide something from us or you are a biggest fool. If your property can earn minimum 3 lakh for you, why are you earning 2,40,000? In this case, no, the actual rent earned by you is not the rent earning capacity. The expected rent determined by us is the rent earning capacity. What will be the GAV over here? 3 lakhs. So will the actual rent be taxable? Yes, but as a part of 3 lakhs. And the extra 60,000 which you have not earned, according to you, which you have not earned, will also be taxed in your hands. Don't you think? Out of the income which you are trying to hide, 60,000 is covered. At least 60,000 got covered. Or if you are actually earning 240, you are earning 60,000 less. Go and give your property on rent to someone who can at least give you 3 lakhs. Getting my point? Charging tax on 3 lakhs, no, pinch you. So this is the case where not just the actual income, real income, but some notional income will also be charged to tax, which I told you in the first lecture itself, first chapter itself, that sometimes there will be cases when not the real income, but notional income will be charged to tax. In this, your real income 240 is also taxed and notional income of 60 is also charged to tax. And that was necessary to do. If you are not doing it, we are relying on your actual rent only. Bloody, you are going to show this also. You are going to show less than this. What if the actual rent which you were earning was 30,000 into 12? Then it was 3,60,000. Yes or no? So are you earning more than our expectation? Then the rent earning capacity of your property is not 3 lakh, it is 3,60,000, which you are earning in the form of actual rent. Pay tax on how much? 3,60,000. Actual amount which you are earning, show it as GAV. Easy or not? Municipal value, no? How to determine? They will never ask you. Because every local authority will have their own rules to determine the municipal value. Yes or no? And you can't have that mind to know that how every local authority around India determines their municipal value. It is next to impossible. Seriously telling you, even I don't know that how they determine the municipal values. Getting my point? I don't know about my own municipality under whose jurisdiction my property falls. I know that there is some property taxes which they are collecting, and to charge that property tax they determine some value. But what rules they are following to determine that value, even I am not aware about that, because that is their internal working. Getting my point? So they will never ask you to determine the municipal value. Don't worry, it will be given in the question only. Can you pick up the value and put it here? Sure. What about the fair rent? From the examination hall, you'll come out, go to Anna Nagar, ask about the 2 BHK rents. What if they are not asking from Anna Nagar, they are asking about Surat, Gujarat. So from exam hall, you will come out and go to Surat. By the time you will reach, no, it will be already 2-3 papers gone. So fair rent amount will also be given in the question only. Don't worry. Can you pick up that amount, identify that amount and put in the format? Yes, that's what you are supposed to do. What is standard rent? It is the rent, maximum amount of rent which the owner can recover from the tenant as per the Rent Control Act. Understanding? If the Rent Control Act is applicable and your property is also getting covered under the Rent Control Act of that state, every state would have their own Rent Control Act. Every state have different types of property getting covered under the Rent Control Act. For different types of property, different type of standard rent will be made applicable. You are not supposed to remember, or you are not supposed to determine that standard rent also. It will be given in the question itself. Either it will be given, then write the amount, or it is not given. Why not given? Because your property is not covered under the Rent Control Act. So that case, you will not write down nil over here. If you write nil, no. So higher amount or nil, whichever is lower, nil. Expected rent will be nil. Will the government ever say that your expected rent of the property is nil? No. So in that case, you are not supposed to write down nil. Standard rent n dot a dot not available. In that case, higher amount will only become expected rent. Getting my point? Now, expected rent you came to know. What is actual rent, sir? What is actual rent? Come on. Actual rent is the rent of the property for the period for which property is actually let out, whether received or receivable. So you have to see that during your ownership period in the previous year, for how many months you have actually let out the property. Have you let out the property for 12 months? Yes. So what is the let out period? 12 months. So whatever the rent is for 12 months, no, that will be your actual rent. Whether you have received or it is still receivable will not make any difference. 12 months rent will be your actual rent. But if out of the ownership period during the year, you have let out the property only for 8 months. So what is the actual let out period? 8 months. So whatever rent for that 8 months will be there, which is let out period, that will be treated as actual rent, whether you have received or it is still receivable. Hello? Actual rent is the rent for the period for which property is actually let out during the previous year. So let out period you are supposed to determine properly. Looking at the question, you will come to know that, okay, out of these many months, how many months the property is actually let out. If the property is let out for the full year, meaning 12 months. So actual rent will be for 12 months. If they are saying that the property was vacant for a period of 3 months, meaning that out of the 12 months availability of the property, 3 months property is vacant, meaning how many months it is actually let out? 9 months. Or they will tell you that tenant has vacated the property on 31st December. So from 1st April till 31st December, the property is let out, and after that the property is vacant. So you will have to read the question properly to determine the let out period. Once the let out period is determined, no, whatever rent for this let out period will be there now, will be your actual rent. Now out of this rent, some rent you have received in this year, but some is still receivable in this year. Will not make any difference whether receivable or received, both taken together. Is it the rent for the let out period? Yes, this is your actual rent. Yes or no? Now please pay attention to this discussion which I am going to do now. Very important discussion. If you learn this now, not a single question in let out property will put you in trouble. Please pay attention. See, what is our previous year? Come on, tell me. What is our previous year? Our previous year. Relevant for our exams. That our previous year is 24-25. Can I say in previous year 24-25, you have the ownership of the property, and ownership of the property is required in 24-25 only. Yes or no? During the previous year. Okay. Now, from 1st April 2024 to 31st March 2025, meaning that starting of the previous year, you are the owner of the property, and you are the owner of the property till the last day of the previous year. Can I say you have the ownership of the property for the full 12 months of the previous year? So if you have the ownership of the property for full 12 months, April to March, you can give the property on rent for your ownership period only, no? Either for the entire ownership period or part of the ownership period, you can let out the property. Tell me, if you are the owner of the property for the full 12 months, can you let out the property for full 12 months? Yes. And you can let out the property for 8 months also. You can let out the property for 7 months also. You can let out the property for 10 months also. Yes or no? Out of 12 months of ownership, you are letting out the property for full 12 months. This is your let out period. Yes or no? Now tell me, can I say here you can let out the property for 9 months also? If you are letting out the property for full ownership period, 12 months you are the owner, and for the entire ownership period, you are letting out the property, 12 months. Is there any vacancy? No. The property is occupied throughout the year by my tenant. The property is not vacant. Understanding? Now, if I am letting out the property for 9 months of my ownership, out of 9 months of my ownership, out of 12 months of my ownership, I am letting out the property only for 9 months of my ownership. That means 3 months during my ownership, the property is vacant. So there is a vacancy of 3 months. Done? Now my first question. Actual rent in the first case will be for how many months? In the first case, how many months actual rent will be there? 12 months, because 12 months is the let out period. In the second case, my actual rent will be for how many months? It will be only for 9 months, because the let out period is 9 months. Did you notice one thing? While determining the actual rent, you gave attention on what? Let out period. If let out period is 12 months, actual rent will be for 12 months. If let out period is 9 months, actual rent will be for 9 months. Sure? Now this actual rent has to be compared with the expected rent also, no? Now tell me, one simple question. Expected rent in the first case will be for how many months? Very good. In the first case, the expected rent will be for 12 months. Second case, come on, tell me. For expected rent, you are not supposed to see let out period. Huh? For expected rent, always see ownership period. What did I say? For expected rent, always see ownership period. So what was my ownership period? Can I say my ownership period was 12 months? So during my ownership period, if for the entire ownership period I am letting out the property, how much rent I can earn? That the government will expect. Forget about vacancy and all. Expected rent will always be for let out period. Color, pink color. Hello. Color, pink color. So tell me, how much is my ownership? 12 months. So for ownership period, expected rent will be there. In both the cases, first case also as well as second case also. First case, how much is my ownership? 12 months. So expected rent will be 12 months. Second case, how much is my ownership? 12 months. So expected rent will be for 12 months. Now tell me, can you compare both of them? Because both are for 12 months. There is no vacancy. Whichever is higher will become GAV. Hello? But can you compare both of them? Whichever is higher. If you make the comparison, no, the comparison will be absurd. Why? Because you are comparing a figure of 9 months with a figure of 12 months and saying whichever is higher. It will not give you desired results because there is a vacancy of 3 months. So now, in the case of vacancy, where the actual rent is for a lower period and expected rent is for higher period, how to determine that GAV? Yes or no? Now wait. Tell me, expected rent, how you calculate expected rent? You will take municipal value. You will take fair rent. Whichever is higher, compare it with standard rent. Then you will get expected rent. Expected rent of 12 months. Expected rent of 12 months. You will arrive at 12 months expected rent only if you take municipal value, fair rent, standard rent of 12 months. Because based on these three amounts only your expected rent is derived. Hello? So municipal value for 12 months. Fair rent for 12 months. Standard rent for 12 months. Accordingly, your expected rent will be for 12 months, which is nothing but your ownership period. Done? Now 12 months expected rent, government is expecting that during your ownership period, if the property is let out, so in your ownership period, how much rent you can earn from your property? This is expected rent, which is for 12 months. Now, out of your ownership period, if you have let out only for 9 months, during those 9 months, how much you are earning? That is your actual rent. Yes or no? Now, you cannot directly compare both of them because there is vacancy. So, what we will do, see, if vacancy is not there, what did I say? If vacancy is not there, that means expected rent and actual rent both are for same 12 months, no? Yes or no? Whichever is higher, I will make that higher amount as my GAV. There is no problem here. Problem will come when there is vacancy. Now, if vacancy is there, so in our example, expected rent was for 12 months and actual rent is for 9 months. Yes or no? I cannot do higher over here. Whichever is higher will become GAV. This will not give me the desired result. So what I have to do, please pay attention over here. See, if vacancy is there, no, so you first check. What you will check? Okay, even if there is a vacancy in the property, in our case, there was 3 months vacancy. Yes or no? Even if there is a vacancy of 3 months, the actual rent for 9 months, can it be greater than or equal to expected rent? Come on, tell me. Even if the property is vacant for 3 months, still the actual rent for 9 months can be a higher amount or equal amount to my expected rent. What if the expectation was for 12 months and that amount was only 3 lakhs? Only 3 lakhs. But I have let out the property for 9 months and monthly rent is 40,000. Come on, tell me. 40,000 into 9. How much is that? 40,000 into 9 will give me 3,60,000. Bloody in 9 months only, I'm earning more than your expectation. Just imagine if the property was not vacant for 3 months, I would have earned more, no? So am I trying to hide something from you? Is my actual rent a bad rent? No. So why are you ignoring it? Take my actual rent as GAV. Because I'm not trying to hide something from you. Yes or no? So even after there is a vacancy, my actual rent can be equal to or it can be more than the expected rent. In that scenario, GAV will always be actual rent. Hello. But second scenario can also happen. Vacancy was there and my actual rent, which is for only 9 months, which is less than expected rent of 12 months. Can this be a possibility? And why this has happened? Come on, tell me. Actual rent is less than expected rent. Why? Because of vacancy. Vacancy is the reason. That is the reason why my actual rent is lower than your expected rent. Oh, you mean to say that if property was vacant for 3 months, hence your actual rent is less than our expectation. Do one thing. Add the vacancy. Add the vacancy period in your actual rent. Let us see whether you are telling us the truth or not. It will be in front of our eyes if we add vacancy rent. After adding the vacancy rent, if the total is equal to expected rent or more, then vacancy was the reason. We will accept your actual rent. Hello. But even after adding vacancy rent, still your total is not more than or not equal to our expected rent. It is still less. Then vacancy is not the reason. Reason is something else. We will ignore your actual rent and we will take expected rent only as GAV. Getting my point? So what I am supposed to do now? I am supposed to check whether the actual rent is lower than expected rent and the reason was vacancy or not. If the reason is vacancy, actual rent will be accepted. But if the reason is not vacancy, then actual rent cannot be accepted. Expected rent will only be treated as GAV. So what will be my step now? I will add actual rent and vacancy rent figures. This will be for 9 months and this will be for 3 months. For those 3 months also, if I would have given my property on rent, how much actual rent I would have earned? That is nothing but my vacancy period rent. Yes or no? So vacancy period rent, I will add to my actual rent. I will now see that this total, if it exceeds or it is equal to my expected rent, no. That means after adding vacancy rent, the total went beyond expected rent and it became equal to expected rent. Vacancy was the reason for my actual rent to be lower. So in this case also, GAV will be actual rent only because vacancy was the reason. See, no, vacancy I added. After adding vacancy, the total actual rent including vacancy was equal to expected rent or it became more than what? Expected rent. Yes or no? That means vacancy was the reason. Now come on, tell me. I added actual rent and vacancy rent. Still the total is lower than expected rent. Meaning that we saw that after adding vacancy rent, still your rent is lower. If for these 3 months also your property would have given on rent, still your actual was lower than our expectation only, no? In that case, we cannot accept your actual rent. This is the case when your GAV will be expected rent. Hello, sir. If you learn this thing, no, then one big hurdle of this chapter you have crossed. Many people find it difficult to determine this value, GAV. Will you be able to do it? Sure. I'll make one more example. Come on. Wait now. What is my previous year? 24-25. During the previous year, 24-25, property was owned, meaning I have the ownership of the property. Yes? So what is the ownership, Wait. It could have been from 1st April to 31st March. Only if I have already bought the property earlier. But what if I'm buying the property for first time in this previous year? Possible or not? I became the owner of this property first time in this previous year. So for me, the ownership period, not necessarily, it will start from 1st April. It will start from the date on which I acquired the property. Yes or no? Example, I acquired the property on 1st of July 2024. So my ownership period will start from 1st July 24 only, no? I was not the owner in April, May and June. I became the owner itself in this year on 1st July. So from 1st July till 31st March, I am the owner of the property. Now tell me, what is my ownership period? Only 9 months. Yes or no? Can I let out the property for entire 9 months? Can I let out the property for 7 months out of 9 months? I cannot let out this property more than 9 months because I don't have ownership more than 9 months. From next year onwards, I can let out the property for full year. Hello? But this is the first year in which this source of income is coming into existence. First year for a new source of income can be a period of less than 12 months. First lecture, remember. First previous year of new source of income can be a period of less than 12 months. Ownership is only 9 months. Can I let out for 9 months? Can I let out for 7 months? Is there any vacancy? No. Second, there is a vacancy of 2 months. Tell me what will be the actual rent. First case, come on, tell me. Actual rent for how many months? Color, yellow color. Do you remember? Color, pink color. Do you remember? So color, yellow color. I have to check let out period. Let out period, actual rent. Then ownership period will give me expected rent. Yes or no? So tell me, how much is the let out period? 9 months, actual rent 9 months. How much is the let out period? 7 months, actual rent 7 months. Done? Tell me, expected rent will be ownership period 9 months, expected rent 9 months. Ownership period 9 months, expected rent 9 months. Now, in such type of questions, what they will do? First of all, they will tell you that the property is bought in this year. Meaning that the ownership period 9 months you have to take. Out of 9 months, 7 months you have let out the property and 2 months property kept vacant. Could not be let out. In such type of questions, to determine the annual value, you need actual rent and expected rent. So to calculate expected rent for 9 months, you need all the figures of 9 months. Municipal value 9 months, fair rent 9 months, standard rent 9 months. Only then the expected rent will be for 9 months, no? Tell me, sir. They have given municipal value of 12 months. What you will do? Divide by 12 multiplied by 9. They have given fair rent per month multiplied by 9. They have given standard rent per month multiplied by 9. Because if these figures are for 9 months, only then the expected rent will be for 9 months. Be very careful here. Ask this thing to any of your friends who are not studying from me. You'll come to know that how much they are knowing. But don't tell them the logics. No, that should be known to you only. Understanding? Come on. Now let's move ahead. First case, can you see vacancy is not there? What will you do? Actual rent of 9 months, expected rent of 9 months, whichever is higher becomes GAV, no vacancy. Second case, there is vacancy, no? Directly compare whichever is higher. What will you do? Even after 2 months of vacancy, actual rent can be equal to or higher than expected rent. In that case, take actual rent only as GAV. Hello, sir. But what if vacancy of 2 months is there, my actual rent is lower than expected rent? What I will do? I will add the vacancy period and check the total now. If by adding the vacancy period to my actual rent, vacancy period rent to my actual rent, if the total is equal to my expected rent or more than my expected rent, still I will take actual rent as my GAV. Yes or no? But even after adding the vacancy rent, the total is still less than expected rent. Then expected rent will be taken as GAV. Understood? All the possibilities done. Now let's come to this part. Read the section number. What is the section number, guys? Section 23(1). This tells you that how to determine the annual value GAV of any let out property, and that GAV is calculated and it will be taxable because that annual value you are exploiting as what? Rent. Yes or no? Tell me. What we will take? Municipal value. Compare it with fair rent, whichever is higher amount compared with standard rent, higher amount or standard rent, whichever is lower, that will give us expected rent. Now expected rent compared with actual rent, forget about this thing right now. Forget expected rent compared with actual rent, we will get what? GAV. Done. Now after you have calculated this GAV, for every let out property, GAV will be calculated like this. Then from that municipal tax deduction, you will get NAV. From that section 24, two deductions are there. Hello? You will get final income of let out property. But that final income will be calculated only if you derive the GAV like this. So we are at the first step here only. Hello? Right now we are discussing that how to determine this GAV for different types of property. Yes or no? Now pay attention. Can you see this UR over here? But before we actually discuss what is municipal value, did I explain? What is municipal value? Did I explain? If you'll read it, no, it will be the same discussion over here. What is fair rent? Did I discuss? What is standard rent? I also discussed. What is expected rent? Yes or no? What is actual rent? And I gave you a few examples. See, whatever I'll be writing, whatever I'll be speaking will be in my notes only. You're not supposed to worry about. Same examples I gave. 1 or 2 months here and there. First, ownership is 12 months. Second, ownership was 10 months. In our second case, we took 9 months ownership. Hello? Here it is ownership of 10 months. Same example. If there is no vacancy. So what are the no vacancy cases? 12 months, 12 months, 10 months, 10 months. In both the cases, there is no vacancy. Yes or no? Case number 1 and case number 3. No vacancy is there. So what we will do? Expected rent or actual rent. Expected rent, actual rent. Expected rent, actual rent. Whichever is higher. But in case number 2 and case number 4, can you see vacancy? So if vacancy is there, case number 2 and case number 4, when vacancy is there, what you do? Actual rent is still equal to or higher than expected rent. Take the actual rent as GAV. If the actual rent is lower than expected rent, then try to add vacancy rent. VR means vacancy rent. If the actual rent plus vacancy rent figure, if this total comes more than or equal to GAV, then that time also you take actual rent only as GAV. Many people commit a mistake over here. What they do, AR plus VR they have done. That total only they are taking as GAV. It will be wrong. GAV can either be actual rent or it can be expected rent. It cannot be any other amount. Vacancy rent you are adding and making a total just for the sake of comparison. That total will never become your GAV. Hello? Either the actual rent will become your GAV or expected rent will become your GAV. Getting my point? So here what will become? Actual rent. What if even after adding vacancy rent, your total is still less than expected rent? Then actual rent will be ignored. Expected rent will be taken as GAV. Done, sir? Everyone? Now in this calculation, now GAV calculation, you will find out this thing. Very important. This is UR. UR means unrealized rent. Unrealized rent. It is a rent only. Actual rent only. Which you could not realize. Which became bad debt. You know, some sales happen. Some sales cash sales. Some credit sales. Credit sale also your income. Cash sale also your income. Hello. But out of your this income, whatever credit sale was there will result into debtors. And that debtor will ultimately turn bad, making bad debts. Getting my point? So apply that same logic. Let out period 12 months. Let out period 12 months. 11 months rent received. 1 month receivable. How much will be actual rent? Let out period 12 months. Out of 12 months, 1 month rent 1 month rent receivable, 11 months rent received. How much will be actual rent? Kanu, actual rent is the rent for the period for which the property is let out. What is the let out period? Don't forget what I have taught. Blindly follow. Actual rent is the rent for the let out. How much was let out period? 12 months. Actual rent will be 12 months. But in that actual rent, 11 months rent is received. And 1 month is still receivable. That 1 month can become bad. That 1 month rent which is still receivable, the tenant can say, I will not give it to you. So that became bad debt. So that bad debt is becoming out of my actual rent only, no? So to the extent of that bad debt, am I recovering actual rent? No. Reduce. They are allowing me to reduce that part of actual rent which was receivable but I could not recover, which became bad debt. Reduce out of actual rent. Understood? Sure? Please pay attention. The same thing which I was speaking. Let out period is how much? 12 months. Out of this received how much? And how much is still receivable? Received plus receivable is 12 months. And for this 12 months, whatever rent is there is my actual rent. Sure? So actual rent will be for 12 months only. Actual rent will be for 12 months. Let's assume that it was 20,000 per month. So can I say 20,000 into 11? 2,20,000 I have already received. 20,000 into 1. 20,000 is still receivable. 2,20,000 received plus 20 receivable. Total 2,40,000. My actual rent will be 2,40,000 only. But something happened that the rent which was receivable, how much? 20,000. This became unrealized. Bad debt, bad debt. Would you like to pay tax on this? Then why are you showing in actual rent? Reduce. Don't pay tax on that amount, no, which became bad debt. Reduce. But first you have to show as income. Then we will allow you to reduce. Hello. Show it as income. In that income, some rent you were supposed to receive, but you could not receive. Reduce. Unrealized rent minus. So you will minus 20,000 over here. Hello. So now how much will be your actual rent? Hello. This is for how many months? This actual rent which remains after reducing unrealized rent, this is for how many months? You immediately fall into my traps, you know. Immediately you all fall in my traps. This is still for 12 months only. For 12 months you are supposed to receive 2 lakh 40, but you did not receive 2 lakh 40. For those 12 months only you received 2 lakh 20 now. This 220 is not 11 months rent. 220 is your final actual rent now, which is for 12 months. For 12 months you were supposed to receive 240, no? For the same 12 months you did not receive 240. You now receive 2 lakh 20 only. So the 2 lakh 20 is your actual rent for your let out period now. So this is for how many months? 12 months only. Earlier you were saying that your actual rent for 12 months is how much? 240, no? Now your same actual rent for 12 months is 220 after taking a reduction of unrealized rent. Got it? So this is for how many months? 12 months only. Now you will have to directly compare it with expected rent. Whichever is higher will become GAV. Sure? Sure. So now tell me, if expected rent was 2 lakh rupees and your actual rent was 240 minus 20, how much? 2 lakh 20,000. What you will do? Come on. Was there any vacancy? No. No vacancy, no? So whichever is higher, how much will be the GAV? 2 lakh 20. Any problem here? Understood? Sure, understood? Wait, I'll put you in trouble now. Wait. What if this expected rent was 2 lakh 30? Instead of 2 lakh, expected rent was 2 lakh 30. This is for how many months? And actual rent 2 lakh 40 was there. You reduce unrealized rent. Actual rent is still for 12 months only, no? There is no vacancy. Actual rent is still for 12 months. But after removing unrealized rent, the amount came less. It became 2 lakh 20 for 12 months. But actual rent is still for 12 months only, no? Now compare. Whichever is higher. 2 lakh 30. If you get this GAV, you will get full marks. You will get full marks. Don't worry. Theoretically, your answer is correct also. But logically, this is wrong. Just imagine, no? Just imagine. 20,000 unrealized rent happened. That 20,000 you reduced, and as a result of that, this actual rent became less. And it became so much less that it came down below the amount of expected rent also. Now, since there is no vacancy, nobody will hear you, expected rent is higher, only that amount will be treated as your GAV. Now, don't you think even after having 20,000 rupees of unrealized rent, you are not getting the benefit of reducing entire 20, still 10,000 is included here. Getting my point? You are getting benefit of only 10,000. Understood? What if that amount was 2 lakh 40? Expected rent was 2 lakh 40. This would have been 2 lakh 40. That entire 20,000 benefit gone. Even after reducing from actual rent, you are not getting any benefit. So what is the point of reducing that? After reducing that, the amount falls. My actual rent amount falls below what? The expected rent. and as a result of that, that expected rent only is taken as my GAV. That GAV, if I'm paying tax, that means ultimately I'm paying tax on my unrealized rent only, no? Here I'm paying tax on 10,000 rupees of my unrealized rent because I'm getting only a benefit of 10,000. What if here it was 2,40,000? Come on, tell me. So here it would have been 2,40,000. Entire 20,000, even after reducing from actual rent, I'm not getting any benefit because that 20,000 automatically gets included here, and of that entire 20 I'm paying tax. So if I will reduce my unrealized rent from actual rent, no, and then I will calculate GAV, no, there is a possibility like this that I might not get the benefit of reduction of unrealized rent. Understanding? I might get taxed on the value of unrealized rent even after reducing it. So what is the easy way, Do one thing. 12 months, your expected rent was 230. 230, no? In first example, we took expected rent 230. 12 months, your actual rent is how much? 240 only. Don't reduce unrealized rent from here. Don't reduce your unrealized rent from here. Take expected rent 230. Take the entire actual rent. Just imagine if we have not reduced our expected rent, our unrealized rent from actual rent. That means I was anyways going to get more as compared to your expectation. Hello. If unrealized rent was not there, I was anyways going to get more than your expectation only, no? So that time, how much would have been my GAV? My GAV would have been 2,40,000. Yes or no? This is my rent earning capacity. And out of this rent earning capacity, which I was supposed to receive, 1 month rent I could not receive. That became my unrealized rent. I will reduce it from here. Now my final balance GAV, which should be taxable to me, is 2,20,000. This is more logical. Even if I take expected rent 2,40,000, no. See, even if I take expected rent 240, come on, tell me. Actual rent 240. Then come on, tell me. Here it will be 240 and I will still get 20,000 benefit. I will still be paid. I'll be still paying tax on 2,20,000 only. That means I'm getting the full benefit of my 20,000. This is more logical. And you won't believe income tax returns when you file, no? In the income tax return, unrealized rent is always reduced from GAV only. And if you are getting these answers, no, don't worry, you will get full marks in the exams also. So there are two ways in which you can reduce unrealized rent while calculating annual value. One, you can reduce from actual rent. Balance actual rent is there. You compare with expected rent and calculate GAV. Hello. And two, don't reduce from actual rent. First compare and calculate GAV. From that GAV, you claim unrealized rent. That way also you can do. See, in the first option now, first option is theoretically correct. Whatever answer you will get, on that full marks will be awarded. But that answer is illogical. You are not getting the entire benefit of unrealized rent. Getting my point? Second point, theoretically not given, but practically in the income tax return, this happens. If you solve like this, get this answer, then also full marks will be given and it is logical also. Which one is preferable? Practical, getting full marks, and logical, this option is better, or theoretical, getting full marks, or illogical, this option is better? Which option is better? Second, no. So what we will do, we will always reduce the unrealized rent after computing GAV. Understanding? You might have a doubt, sir, what if here it was 2,60,000? So anyways you are going to pay tax on 260, no? Anyways you are going to pay tax on what? 260, no? Unrealized expected rent. So even if you reduce unrealized rent from here or later, hello, expected rent is higher. Even before reducing unrealized rent, it is higher. If you reduce unrealized rent from actual rent, still it will be higher only, no? So directly compare, calculate GAV, then reduce. Directly compare, how much is the GAV? 2,60,000. Reduce, how much will be there? 2,40,000. Hello? Getting my point? This should be your correct answer. But what if you have already reduced from actual rent? Now actual rent become 220 and expected rent 2,60,000 will be taxable. You're not getting that benefit of 20,000. Getting my point? Out of the entire year's value which you are charging 2,60,000, 20,000 is my unrealized rent. No, give me the benefit of that 20,000. No. If I'm reducing that out of my actual rent and still your expected rent is getting taxed as my GAV, what is the benefit happening to me? So it is better not to reduce only. Got it? Sure? But wait, whenever we'll solve our answers, no, we will always first compare expected rent and actual rent. From actual rent, we will not reduce what? Unrealized rent. Sure? Once we are calculating GAV, no, after that GAV, we will reduce unrealized rent. And we will write down a note without fail that the unrealized rent in the above solution is reduced from the amount of GAV as per the treatment given in ITRs. Alternatively, it can be reduced from actual rent also, and in that case the GAV would have been this much. That's it. Understanding? Don't worry, you will get full marks because in our ICI study mat, no, whatever questions institute has solved, institute has also solved in that manner only. I will show you, don't worry. But first of all, what we will take? Come on, tell me. We are calculating the annual value of let out properties. First, we will take the municipal value. Then we will compare with fair rent. Whichever is higher, that higher amount will compare with standard rent. We will get expected rent. This expected rent should always be for ownership period. If nothing is mentioned in the question, we will assume that the ownership is for the full year. And if it is mentioned in the question that the property was acquired in this year only, be very careful. Ownership period is less than 12 months. Expected rent needs to be calculated for ownership period only. Understood? Expected rent calculated, then take actual rent. Actual rent is the rent for the let out period. Hello? Whether received, that also you take. Receivable, that also you take. But out of this actual rent, if some unrealized rent is there, that will be given in the question. Don't reduce from actual rent. First, compare expected rent and actual rent. Calculate GAV. How to calculate GAV? You know na. If there is no vacancy, directly compare. If there is vacancy, add vacancy rent and all. Hello? GAV is calculated. From that GAV, reduce unrealized rent. Balance GAV will be your final taxable annual value. Hello? From that you will reduce municipal taxes paid. You will get NAV. Out of that you will get 24 clause A standard deduction, 24 clause B interest on housing loan deduction. What will be there? Your final income from house property of this let out property. Likewise, for every let out property, you are supposed to calculate in the same manner. Got it? Please pay attention over here. See. Now, can you see unrealized rent over here? Wait, 1 minute. See, unrealized rent. It is that part of actual rent. First of all, please be very careful. Unrealized rent is actual rent only. It was a part of your actual rent which you could not realize. Hence, it is eliminated from annual value calculation. You can eliminate by eliminating from actual rent also. You can eliminate by eliminating from GAV also. Where would you like to do? Eliminating from actual rent? No, eliminating from GAV. Got it? Okay. Could not be recovered from the tenant. It is reduced from actual rent while computing the GAV. See, this is important. Alternatively, as per the treatment given in the ITRs, it can also be reduced from GAV. Both the treatments are correct. Okay. Now, if you want to reduce the unrealized rent now from your GAV calculation, hello, from your GAV calculation, if you want to reduce what? Unrealized rent. Where you can reduce? Actual rent also you can reduce. And from GAV also you can reduce. You can reduce it only if, what did I say? You can reduce it only if four conditions which I am going to talk now. All the four conditions of Rule 4 are fulfilled. Now, can you see these four conditions on your screen? Read them one by one. These four conditions must be satisfied. All the four conditions. Only then unrealized rent you can reduce while calculating GAV. Wherever you want to reduce from actual rent or you want to reduce after GAV, wherever you want to reduce, you will be able to reduce it only if all these four conditions of Rule 4 are fulfilled. So in the income tax rule, Rule 4 is there. In the Rule 4, these four conditions are given. All these four conditions must be fulfilled. Number 1, tenancy must be bona fide. Meaning tenancy must be legal. There is a legal agreement between you and the tenant for the tenancy. And as per the legal tenancy, this amount is legally receivable which you could not receive. Yes or no? Which became unrealized. Any illegal tenancy was there. So the unrealized rent is also illegal. We will not allow. So legal tenancy will be only if the tenancy is bona fide. Bona fide means there is a rent agreement between you and the tenant. Yes or no? So first condition, tenancy must be bona fide. Second condition, the defaulting tenant who has not paid you unrealized rent, no, he should vacate your property. He has vacated your property. Or if he has not vacated, you have taken all the legal steps to compel him to vacate your property. Why the bloody hell you have still given your property on rent to him? Just imagine. There is something fishy. Because knowing that he has not given you rent, still your property is on rent to him. This is something which arises doubts. What is the guarantee that he will not do unrealized rent again in the next year? This year also he has done. Again in the next year he will do. And still you have given your property on rent to him. You have not compelled him to vacate. Meaning that you might have actually received that rent from tenant in cash. And claiming it to be unrealized rent from us. And he has done so much of good favor to you. So you are still keeping him as tenant. So that again in the next year, you both can fool us like this. Understanding? Government is very smart. Thinking something they have put these kind of conditions. Yes or no? So genuinely, if he has done unrealized rent and you want to claim it as a reduction while calculating the annual value, he should not be there in your premises. Vacate the premises or compel him to vacate the premises. Wait. That is not the only thing which you have to do. Make sure he is not occupying any other property belonging to you. Just imagine if other property is given on rent to him. This time you are doing this in this property. Next time in your other properties, you and him will try to fool us. So if other properties are given on rent, no, tell him to vacate those also. And last but not the least, just saying that it is my unrealized rent, give me as a reduction while calculating annual value will not be sufficient. Show us the proof that you have taken some legal steps to recover that unrealized rent, and even after taking the legal steps, you could not recover. Without taking legal steps, you are saying that you are not able to recover. Definitely, you are not going to recover only. Take legal steps now, you will be able to recover. But you have not taken legal steps. How can we allow? So, take the legal steps to recover the unrealized rent. But sometimes it is not practically possible to take the legal steps. Why? He has died. Now, should I file a case against him? So, what legal steps should I take now? He has died now. He became insolvent. See, there is a court order, insolvency order on his name. Now, what legal steps should I take? He's bloody not paying his other creditors. How would he pay my unrealized rent? Hence, I have not taken the unrealized rent. That you have to satisfy. If you have not taken the legal steps. Getting my point? Otherwise, you have to take the legal steps also. All these 4 conditions must be fulfilled. Only then unrealized rent will be allowed while calculating your annual value. Got it? So this is one by one, brick by brick. We are erecting a building. Now this building will stand so tall now. Just be with me for some time. You will come to know that how easy this chapter I have made for you. The moment you will start solving the questions, the answers will come like this. But the base should be strong. Okay. So pay attention. This is unrealized. Now we are coming to which? 23(2). How many types of properties are there? Come on, tell me. How many types of properties? One is let out. One is self-occupied. Let out property we have already seen. But those properties which we have self-occupied. For what? Our own business or profession. That property is not coming here only. So this self-occupied property is which self-occupied property? Which we have kept for our residential use throughout the year. Or throughout the year we have self-occupied and kept them vacant. Or part of the year self-occupied and part of the year kept vacant. That means only those properties will be treated as self-occupied properties from which we are not deriving any economic benefits. Getting my point? All such properties are my self-occupied properties. Now tell me, out of all such self-occupied properties, any 2 self-occupied properties, I've already told you, any 2 self-occupied properties, the annual value can be exempted. Option is given to the assessee. So take the option. Out of all your SOPs, treat any 2 SOPs as exempt. Claim the annual value exempt, yes or no? What about the balance SOPs? Treated as DLOP. It is written here. See? Remaining SOPs, DLOP. So if you have only one SOP, the annual value of that SOP will be exempt. There is no SOPs to be made as DLOP. Yes or no? If you have 2 SOPs, both the SOPs you can claim exemption. There are no properties to be called as what? DLOP. But what if you are having more than 2 SOPs? Any 2 SOPs at your option, the annual value will be exempt. Remaining SOPs will be taxable as a DLOP. Hello. Remaining SOP, the annual value will be taxable under 23(4). 23(4) is what? Deemed let out properties. Got it? Now this exemption under section 23(2) for your SOP is available only if you are individual or HUF. Because only individual or HUF can use the property for residential purpose, no? Company cannot say that my property is SOP, give me the SOP exemption. No, company cannot say if company is the owner. Firm cannot say that my property, give me the exemption. SOP exemption. Who can claim this SOP exemption? Only individuals and HUFs. So if you are an individual, hello sir, if you are an individual or you are a HUF, you can claim exemption for any 2 SOPs, take their annual value 0. So even if the question is giving municipal value, fair rent, standard rent, municipal tax, etc., all the details of that property, ignore all the details. Hello? Because you are supposed to take the annual value as nil for these two SOPs. Balance SOPs, all the details you will consider, and based on that you will calculate the annual value of balance SOPs, because those will be treated as DLOPs. Everyone understanding? Okay. Now tell me, remaining SOPs, GAV will be taxable as per section 23(4). They will be treated as DLOP. Now how to calculate the annual value of DLOP? Annual value of DLOP is taxable, no? How to calculate? Do you know this kind of thing you did for let out property also? You will take municipal value. You will take fair rent, whichever is higher amount compared with standard rent, you will get lower amount. Lower amount is expected rent. Done. Will there be any actual rent over here? These are actually let out property as per 23(1) or as per 23(4). They are deemed let out. Deemed let out properties will never have actual rent. So what will happen over here, whatever expected rent has been there, no, that will be directly treated as GAV for all the DLOPs. And this is a notional amount, imaginary amount, which you could earn from your property. On this amount you pay tax. Hello, sir. I hope the things are clear till here, everyone. So next lecture, what we are going to do? Next lecture, we are starting the discussion of municipal tax. Because now we know that for let out property, how to determine annual value. For self-occupied property, for deemed let out property, how to determine annual. Till GAV calculation we know. Now after GAV, what steps we are supposed to take? Municipal tax. Then two deductions are there. 24 clause A, 24 clause B. We will discuss them first. And then after discussing the deductions and all, we'll start solving the questions. We'll solve few questions, and then what we will do? Then we will discuss about other types of properties. Partly let out, partly self-occupied based on time. Partly let out, partly self-occupied based on area. Then what if the property is held by you as a stock in trade? Yes or no? Then what if the property is outside India? Then what if there is a co-ownership in the property? What if there is a rent which is coming to you? That rent is for your let out property as well as other asset which is let out with the property. Combined rent is there. Then deemed ownership concept is there. What if there is a recovery for unrealized rent and arrears of rent in this year? Every damn single thing we are going to discuss. But first, we will be discussing what? The municipal tax and two deductions. Then we will solve few questions based on the basic understanding. We'll have proper grip on the concepts along with problem solving, and then the balance concepts we will be doing. No, those concepts will also be easy for us. Done. So we are meeting in the next lecture. Till then, please revise the stuff. I'll pass on these notes today. Okay. And revise, and then we'll meet tomorrow. Sure. Same time. Bye bye.